Great. All right. Welcome back, everyone, to day 2 of the Monetary Economics Conference. Our first presenter today is Kee-Youn Kang. Kee-Youn, you have 30 minutes.
Okay. Can you see my slide? It's okay.
Yes, we can see.
Okay. Thank you very much for inviting me here. And the topic that I present today is digital currency and privacy. So nowadays, electronic payments such as debit cards, PayPal, and even credit cards are widely used in a daily transaction. And one of the key differences between traditional cash and electronic money is that cash retains user privacy, but e-money transactions are collected by the company that operates the e-money system. And this payment data, combined with the user's personal information, can be used for commercial purposes, and their importance has increased with advances in analytical technology such as machine learning. However, there are still limited studies in privacy issues in monetary economics, and so here, so we construct a monetary model in which a private company issues e-money and estimate consumers' preference using e-money transaction data and sell the preference information that can be used to produce more customized product. And we use the model to study under which condition e-money is circulated in Equilibria. And what is the welfare implication of the e-money business? Is it good or bad to the economy? And how monetary policy affects the e-money business? And how market structure, in particular, the degree of competition among e-money issuers affects on real allocations and welfare. And finally, we study the effects of introduction of CBDC. And let me briefly talk about the main result. So in the modern economy, the value of preference information increases with the trade volume. And the trade volume itself increases with the probability that buyers can consume customized products. And that probability also depends on whether the company or even issuers runs its business or not. And that also depends on the value and the price of preference information. So therefore, there are reinforcing interactions between the value of preference information and the trade value. As a result, we can have multiple equilibria. So an equilibrium with e-money and an equilibrium without e-money. And in the model, e-money business improves welfare whenever the company runs the business. However, sometimes the company does not run the e-money business because it cannot make positive profit, even though running the e-money business and using privacy data is good to the economy. So when left to the market process alone, socially efficient privacy utilization may not occur. And when multiple e-monies are circulated, the government can achieve a Pareto improvement by imposing a price ceiling on the preference information. And finally, an introduction of CBDC improves welfare by allowing socially efficient privacy utilization. Okay. And the paper is related to 3 branches of literature. First, studies on privacy in using monetary model. Second, CBDC, and also digital currency literature. Now let's talk about the model. The model is based on Laus-Wright model, and it is the infinite horizon model with 3 sub-periods. So morning, afternoon, and evening. And there are unit mass of buyers and sellers. So here, capital X and H are consumption and labor in the morning market. And small q and HAT are consumption, labor in the afternoon market. And finally, small x and HE are consumption and labor in the evening market. Here, 1 of P. This is an indicator function that equals 1 if buyers provide their personal information to the third party. And delta is the disutility from providing personal information to the third party. Of course, these utility functions, V and U are concave function, and this utility function C is convex function. And at the beginning of the morning, buyers are subject to an idiosyncratic preference shock. So with the probability rule, a buyer goes to the afternoon market, and we call those buyers early buyers. And with the probability 1 minus rule, buyers go to the evening market, and we call them late buyers. And this preference shock is realized at the beginning of the morning. So that means that when a buyer makes a portfolio decision, he knows that which sub-market he will go. So afternoon or evening market. So it's based on Lagos-Wright model. So I adopted a bunch of modeling assumptions. So 1 unit of labor produces 1 unit of perishable consumption goods in each sub-period. And there are comparative markets in the morning and afternoon. And there are pairwise meetings in the evening market. Now we use bargaining, a Kalai bargaining solution with theta as the seller's bargaining power. And here theta is strictly positive. So seller has some positive bargaining power. And there is no recorded keeping device, and agents are anonymous. So an asset is necessary for trade to occur. And the government provides fiat money that grows at a constant growth rate of gamma. And we call this fiat money P money to emphasize that it is paper money. Okay, now I'm going to talk about 3 important assumptions, modeling assumptions. First, evening pace. So there are n different number of tastes for evening goods, and a late buyer has one of those tastes with a probability 1 over n in each period. And each buyer's taste is realized at the beginning of the evening. And if a buyer, in particular a late buyer, consumes customized goods tailored to his taste in the evening market, then he enjoys higher utility that is captured by parameter alpha. So alpha is high if buyer consumes customized goods, and alpha is low otherwise. And sellers can produce a customized product tailored to a particular taste only if the seller prepared the production of that product at the beginning of the evening by incurring zeta units of labor inputs in the evening market. And more importantly, in each period, n number of evening tastes are randomly chosen from an infinite set of different evening tastes. So the set of realized evening tastes changes over time. So for example, in this year, there are a group of late buyers who want to consume pasta, for example. But next year, there are no buyers who want to consume pasta. So the probability that a particular evening taste is realized in a given period is 0. That implies that sellers cannot prepare the production of customized goods without information of a realized evening taste in the current period. Okay. And the second modeling assumption is e-money. So there is a private company owned by buyers, and the company issues e-money, digital cash, that is fully backed by P-money. For example, in this economy, the government prohibits private sectors from issuing purely fiat money to keep the control of the monetary policy. We assume that, of course, the company can observe e-money transaction data, and the company can obtain the information about evening taste realized in the current period by analyzing e-money transactions in the afternoon market. And the information is correct with a probability kappa of B. And this probability increases with mass of early buyers who use e-money in the afternoon market. And as I said before, if a seller knows this preference information, he can prepare the production of customized products tailored to evening taste realized in the current period. And by producing customized goods in the evening market, the seller can increase the total trade surplus and hence the seller's trade surplus. So therefore, sellers have some incentives to buy the preference information from the company. But when a buyer opens an account at the company in the morning to use e-money, a buyer incurs delta units of the fixed utility for agreeing that the company can use personal information, including payment data. So a buyer wants to keep its privacy, but by using e-money, he reveals his personal information to the company, and he hates it, so he incurs some disutility. But the company needs e-money transaction data in the afternoon market, so the company should make early buyers to use e-money in the afternoon market, so the company provides rewards. So rewards can have two forms: fixed rewards and proportional rewards. So if an early buyer uses e-money in the afternoon market, the company provides a certain amount of fixed rewards in the next morning. Second, the company subsidizes a certain fraction of payment in the afternoon market if an early buyers use e-money to make payments.
Sorry, just one clarification. Is this utility exogenous or some endogenous reason?
So this utility is a fixed one, exogenously given.
I see, exogenous. Okay, thanks.
Yeah. And next lemma shows that if a company provides some positive proportional rewards, then the company can always increase its profit by reducing the proportional reward and increasing the fixed reward. So in Equilibria, the company does not provide any proportional rewards. It only provides fixed reward to attract early buyers to use e-money in the afternoon market. And that's it for the model description. Now let's talk about the equilibrium. So equilibrium characterization. And there are two types of equilibrium: P equilibrium and E equilibrium. So P equilibrium, here, no one use e-money. So all buyers use P-money issued by the government. And in E equilibrium, early buyers use e-money. And this figure shows the parameter space for the existence of each type of equilibrium. And here on the vertical line, I put the parameters that are related to the cost of using privacy information. So and time zeta is the seller's investment cost of producing to prepare the production of customized goods. And rho times delta is the early buyer's utility cost. As you can see here, obviously, as this cost increases, we have P equilibrium. That makes sense. As this cost increases, the company cannot make positive profit, so it does not run the business. So everybody use P money. And on the horizontal line, I put the inflation rate gamma. And as you can see here, as gamma increases, the equilibrium type changes from equilibrium to P equilibrium. So the intuition is as follows. In this modern economy, an increase in seller surplus by producing customized products increases with the trade volume in the evening market. So as the trade volume in the evening market increases, the seller has a higher incentive to buy the preference information, which raises the price of preference information, so the company can make positive profit. But the trade volume depends on late buyers' money balances, which also depends on the inflation rate. So if inflation rate is sufficiently high, late buyers carry less amount of money to the evening market. So the seller has low incentive to buy the preference information, so the company cannot make positive profit. And another point is that in the intermediate range here, we have multiple equilibria, P equilibria and also E in equilibria. So this is because late buyers' real balances increases with the probability that the late buyers can buy customized goods in the evening market. So they carry more money into the evening market if they can buy customized goods. In the intermediate range, the equilibrium type depends on late buyers' expectation. So if late buyers expect that, okay, I can buy customized goods, then they will carry sufficient amount of money into the evening market that incentivizes sellers to buy the preference information, so the company can make some positive profit. So we have equilibrium. On the other hand, if late buyers expect that I cannot purchase customized goods in the evening market, then they will carry less amount of money into the evening market, that which disincentivize sellers from purchasing preference information, so the company cannot run its business, so it does not issue any e-money. So the late buyer's expectation is correct. So we can have multiple equilibria depending on how late buyers form their expectation. Okay, now let's talk about
Kee-Youn, can I ask you a question?
Yes.
So I think I'm missing some like big picture thing about why currency is kind of the only way to have a market for information here. That's kind of the unique thing about e-money, is that gives them a technology to collect this information. But why not without e-money? There's some market for information that would arise. There's some like standard market failure that comes there. Maybe that's related to a question Peter asked in the chat.
It's kind of modern assumption. So I assume that okay, late buyers cannot meet any sellers. So the late buyer cannot reveal their personal information like preference information to sellers. So the only way the sellers can obtain the information is from buying information from the company. They can obtain the information by analyzing e-money. So that is kind of black box.
That's an assumption.
Yeah,
that's an assumption. So you're shutting down any market for information outside of using e-money.
Yes, yes. Maybe, for example, clicking the website. I mean, I rule out that kind of possibilities. Yeah.
Okay, thanks.
But I mean, it's also
So-
shutting down the customers providing their own information, right?
Yes, so basically, I assume that, more precisely, I assume that sellers should prepare the production of a customized product before late buyers learn their preference. And this preference information is revealed by analyzing early buyers' transaction data. Yeah. So there's no way that late buyers reveal their information.
So, but could I follow up on that? Because that was the thing I didn't understand. It sounds like the late buyers don't know what type of goods they want, but somehow their behavior in the afternoon is revealing what they're going to want, even though they don't know it. What am I missing?
Yes, that's correct. So there are two types of buyers, early buyers and late buyers. And early buyers' behavior somehow provide information about late buyers, some kind of a trend or a fad in the market. Yeah.
And it's something the late buyers don't even know about themselves yet. And that's why they can't pre-order.
Yeah.
Okay.
That's why you need to trust the recommendations on Netflix.
Exactly.
Yes, that's a very good point. Yeah, right. Yeah. So, for example, I don't know what is the current fad in fashion, but maybe I can learn later, right? Here I use some of expected utilities across agents in steady-state equilibrium as our welfare measure. And the first two terms are trade surplus in the afternoon market, and the second term is trade surplus in the evening market. And the last term is welfare cost that comes from using privacy information. So this term N times delta is the investment cost, and rho times delta is privacy cost. In this economy, e-money business improves welfare by allowing late buyers to consume customized goods, but it negatively affects welfare because of privacy costs and sellers' investment costs. But in the modern economy, the first term effect dominates the second effect, so therefore e-money business improves welfare whenever the company runs the e-money business. However, it does not imply that the company runs the business at a socially efficient level. So this figure shows the welfare under each type of equilibrium. The dotted line is a hypothetical welfare if the economy is in a particular equilibrium. So as you can see here, if the inflation rate is higher than gamma 1, then the economy is in P equilibrium. So the company does not run its business because it cannot make positive profit. However, socially, it is good to utilize early buyers' payment data. Okay? So socially efficient privacy utilization does not occur in some cases. So up to now, I assume that there is a monopoly company. Now let's introduce competition. So suppose that there is a pool of infinite number of companies that can run the e-money business with their own e-money. And so buyers can use different types of e-monies, but the buyer must incur the privacy cost delta for each account that he opens to use different types of e-monies. And sellers buy, of course, by preference information from a company that sells the preference information at the lowest price. And if there are multiple companies that sell preference information at the same price, then sellers randomly choose one company among them. The introduction of competition does not change the trade volume in the afternoon and evening markets, and the existence of each type of equilibrium is the same as in the baseline model with monopoly company. However, due to free entry condition, each company makes zero profit because they have to sell the preference information at a lower price. So the introduction of competition into the e-money business moves the monopoly company's surplus to sellers. So now the seller purchase preference information at a lower price. Furthermore,
Question.
Yeah.
So every company would have the same amount of information, even though their bundle is only used by a subset of the buyer. Is that?
so
I see.
in equilibrium, so the buyer will use any e-monies as long as the reward is higher than the privacy cost, and the probability of obtaining correct information depends on the mass of early buyers. I can introduce the assumption that, of course, to get the correct information, early buyers must use a certain amount of e-monies, but as long as that amount, fixed amount, is not so high, I can get the same result. So the key point is that the probability of obtaining correct information depends on the mass or the number of e-money users. Yeah, that's why as a result, in equilibrium, any e-money issues obtain the correct information.
Kee-Youn, you have 3
Okay.
minutes.
Oh yeah. So we can have multiple equilibria, e-equilibria, with the different pairs of number of e-money issuers and the price of preference information. And each company sells preference information to this mass of sellers. So that means that as the number of e-money issuers increases, the preference information price increases given zero profit condition. That means that when under some condition, as the number of e-money issuers increases, sellers' surplus decrease because they have to buy the preference information at a higher price. But early buyers receive rewards from more e-money issuers. However, early buyers also incur private cost more for using more number of e-monies. So early buyer surplus do not change. And an increase in the number of e-money issuers only decreases seller surplus and welfare. That means that there exists Pareto ranked multiple equilibria, and equilibrium with only one number of e-money issuers has the highest welfare. So in here, the government, so we have multiple equilibria, and the government can pick one equilibria by imposing price ceiling, such that only one company can make positive or non-negative profit by learning the e-money business. So when multiple e-monies circulate in the economy, then the government can achieve parity improvements by imposing the price ceiling on the preference information. Finally, I introduced CBDC into the economy, and I assume that central bank does not provide any interest on CBDC to focus on privacy issues. And the government can design CBDC such that the government can observe CBDC transaction data, therefore buyers in-person BC utility. And government can also recover preference information by analyzing early buyers' CBDC transaction data in the afternoon market. And moreover, I assume that the government doesn't provide preference information to sellers for free. So therefore, private company cannot sell preference information, so they cannot make profit. And introducing CBDC in this way does not change equilibrium outcome, real allocation, but we have unique equilibria for any inflation rate. That means we can support socially efficient privacy utilization. So as you can see in this figure, so that panel shows the welfare with the CBDC. On the other hand, the right panel shows the previous result. So without CBDC, this dotted line, blue dotted line, when the inflation rate is higher than gamma 1, we cannot enjoy socially efficient privacy utilization. By introducing CBDC, we can raise welfare. I also extended model by introducing heterogeneous disutility, but the main result does not change. So let me summarize. So number of e-money users decreases with inflation and the company runs the e-money business only if inflation is sufficiently low. And when left to market forces alone, socially efficient privacy utilization may not occur. And when we have multiple e-monies in the economy, then we can achieve product improvement by imposing price ceiling, and introduction of CBDC can improve welfare by supporting efficient privacy utilization. Okay, that's it. Thank you very much. Yeah. Any questions?
Thanks, Kee-Youn. So we'll move on now to our next speaker. Kee-Youn, there's a question in the Q&A that you should address.
Yes, yeah.
Afterwards. Thanks. Great. Our next speaker is Duhyeong Kim.
Okay. Can everybody see my screen?
Yep.
Yeah. Thank you very much. I'd like to say thank to conference organizers, Zach, you, and others for having me at this conference. In this paper, I develop a model of money and credit, where credit is allocated by financial intermediaries. And the main friction of the model is going to be private information and costly monitoring. Before talking about my modeling details, I'd like to talk about what has been done in the literature that studies the roles of money and credit as a means of payment. A key finding in the literature is that money and credit are substitutes. As the inflation rate rises, the use of money decreases while the use of credit increases. So there's this substitution. The quantity of credit increases in these models because a higher inflation rate decreases the value of default of borrowers. Okay, and this mitigates the incentive problem and allows lenders to extend more credit to borrowers. Okay, and the question is, are money and credit always substitutes? Is there any way to make them complements? So I could answer this question with this paper because I take a different approach to modeling money and credit. And at the end of the day, I'm going to show whether money and credit are substitutes or complements. And also, I'm going to study the effects of monetary and financial frictions on the choice of means of payment with my model. In my model, credit is allocated exclusively by financial intermediaries, which is an extreme assumption. But I'm going to focus on intermediated credit because it is common observation in practice, right? And then a question is, why do we need financial intermediaries? Okay, one explanation is that they have cost advantages in processing information. In the work of Diamond and Williamson, economic agents delegate monitoring tasks or information processing tasks to financial intermediaries because they can do these tasks in a more cost-effective way. Okay, they have diversified portfolios, and economic agents can avoid duplicate monitoring efforts on borrowers by delegating monitoring tasks. Okay, and another explanation is that financial intermediaries have higher credibility than anonymous agents. In the work of Gu, Mattesini, Monet, and Wright, economic agents with higher discount factors become financial intermediaries in a world with limited commitment, and liabilities issued by these intermediaries can be used as a means of payment. Okay, I'm going to introduce these roles for financial intermediaries into the model based on Lagos and Wright and Washington and Wright. And the cost of using credit comes from private information and costly monitoring, similar to Williamson and Diamond. But in my model, financial intermediaries are assumed to be special agents who have costly monitoring technology. And the financial intermediaries in my model are not subject to limited commitment, which is different from Gu, Mattesini, Monet, and Wright, but liabilities issued by these intermediaries can be used as a means of payment, as in Gu, Mattesini, Monet, and Wright. In particular, okay, I have buyers, sellers, and banks in my model, and each buyer will receive a preference shock, which is high or low. And this preference shock is going to be private information to the buyer. And with the monitoring technology, financial intermediaries will write deposit contracts with buyers before shocks are realized. Okay, and then these deposit contracts will provide state contingent claims on goods to the buyer in equilibrium, which means that if the shock is high, then the buyer is going to receive a larger quantity of claims. And if the shock is low, then the buyer will receive a smaller quantity of claims in equilibrium. Okay, that's an overview of the model. And then there will arise an incentive problem, which I will show later. And this paper is related to broadly two streams of the literature, but I'm going to skip the literature review for today. And here's the model. It's based on a simplified version of Lagos and Wright. And I have different types of agents at the onset. Continuum of buyers, continuum of sellers, and a continuum of banks in the model. Most things are standard, but what is not standard is that buyers face preference shocks, which is represented by this theta t tilde. Okay, and if theta t tilde is either greater than 1, okay, and if theta t tilde is 1, then I will call this buyer a low type buyer. And if theta t tilde is theta, then I will call this buyer a high type buyer. Okay, there's nothing special in sellers' preferences, and banks or agents who can produce and consume in the centralized market. So XT is the bank's consumption, and HT is the bank's labor supply in the centralized market. And what they can do in the decentralized market, DM, is that they can put labor effort on monitoring buyers' preference shocks. Okay. In the CM, buyers exchange goods to acquire money and deposit contracts. And banks write deposit contracts with each buyer depending on the buyer's money holding. And I assume that banks can observe the buyer's money holdings in my model. In the DM, the preference shock is realized at the beginning, and each buyer reports the shock to the bank. And after receiving the report, the bank will determine whether to do the monitoring or not. And if the bank decides to do the monitoring, then it incurs gamma units of labor effort. Okay, and then each buyer is matched with a seller, and the buyer makes a take it or leave it offer to the seller, which is also a simplifying assumption. And there arises an incentive problem because monitoring is costly, and the quantity of claims will have to be dependent on by each buyer's report, right? So low type buyers will have incentives to claim to be high type, because by doing so, they can get a larger quantity of claims from the bank. So banks will have to conduct the monitoring with a positive probability when a high shock is reported. They conduct monitoring with a positive probability, not 100%, because 100% monitoring is costly, so it's not optimal. Okay, and they conduct monitoring only when a high shock is reported, because there will be no incentives for high type buyers to claim to be low type. Okay, and here is the sequence of events. I told you almost everything except that after this reporting and monitoring stage, there is this payment shock. So what does that mean? If you receive a payment shock, the seller you're matched with will only accept money in the transaction. Okay, that's the payment shock. And I assume an asymmetric payment shock in the sense that this payment shock happens only to low type buyers. Okay, this asymmetric payment shock assumption will give me analytical tractability. And I will also tell you what would happen when there is no payment shock at the end. Then the result is going to be very different. So it's interesting too. Okay, so for now, let me assume there's a payment shock to low type buyers. And after observing the payment shock, the buyer and the seller participate in a credit transaction where bank deposit claims are used as a means of payment. Okay, when there is credit transaction, what happens here is that the deposit contract between the buyer and the bank turns into a credit contract between us, the seller and the bank, because the seller will accept deposit claims from the buyer, but these deposit claims will be redeemed in the next period. So the seller has to wait to get the claims, right? The goods. So I will use these terms, bank deposit claims and credit, interchangeably throughout the presentation. And after these credit transactions, there will be currency transactions. If the buyer and the seller want to participate in a currency transaction, then they can use money as a means of payment to trade goods. Okay. So what happens in equilibrium is that if you're a low tide and if you can use your credit in credit transaction, then the quantity of credit for this low tide buyer is going to be enough to support first best quantity for the low tide buyer, which is actually larger than the first best quantity. So in this case, the buyer does not want to participate in a currency transaction. But if you're a high tide, then what happens in equilibrium is that the quantity of credit for high tide buyers is smaller than their first best quantity. So the buyer will participate in a currency transaction to increase their consumptions. Okay, that's what happens in equilibrium. And in the next centralized market, banks will produce goods to repay their deposit liabilities. And here is bank's problem in equilibrium. I don't think it's necessary to go through all the details of the notations, but I want to highlight that each bank chooses deposit contract, terms of the deposit contract, K, XL, XH, pi L, pi H, to maximize the buyer's expected utility in equilibrium. Okay, all the banks have to solve this problem, because otherwise, so suppose all the banks do not solve this problem in equilibrium, then there will be another bank who writes a deposit contract that gives a higher expected utility to buyers. Then this bank will attract all the buyers from the economy. So that's not an equilibrium. That cannot be an equilibrium. So all the banks have to solve this problem. And this problem is subject to 4 constraints. And the first constraint tells us that the expected discounted payoff for the bank from writing the deposit contract must be non-negative. And this is going to be 0 in equilibrium for the same reason I mentioned earlier. Okay, and the second constraint is the incentive constraint for the low tide buyer to report their shocks truthfully. And this constraint is going to bind in equilibrium. The third constraint is the incentive constraint for the high tide buyers to report their shocks truthfully. And this constraint does not bind in equilibrium. And the last constraints are feasibility constraints, meaning that all the quantities must be non-negative, and the probabilities of monitoring must be between 0 and 1. And here is a buyer's problem in the centralized market. Each buyer chooses the quantity of money holding to maximize the buyer's expected utility. The objective function is the same as before. But each buyer knows that his or her money holdings will change the bank's deposit contracts, because banks will solve the problem given the buyer's money holding. Okay, so this is the problem. And after getting the deposit contract, there's no incentive for buyers to change their money holdings in equilibrium. Okay, and here's what happens in equilibrium. Here are first order conditions to the bank's problem. When monitoring cost gamma is sufficiently low and inflation rate mu is sufficiently high. Okay. And as you can see in equation 10, there is a negative term on the right-hand side. This means that the quantity of claims for low-type buyers, which is XL, is larger than their first best quantity, XL star. Okay. And as you can see from the equation 11, there's a positive term on the right-hand side, implying that the quantity of claims for high-type buyers is constrained in the sense that the quantity of consumption for high-type buyers, which is XH plus M, is smaller than their first best quantity of consumption, which is XH star. Okay, so these results come from this incentive problem due to the private information and costly monitoring. And here is the first order condition to the buyer's problem in equilibrium. The left-hand side is the expected marginal benefit from holding one more unit of money. And the right-hand side is the marginal cost of holding one more unit of money, which is going to be inflation rate, mu. Okay, this money, if you are a low type, and if you are matched with a seller who accepts credit, then this money is going to be used to increase your consumption. So with probability 1 minus P times delta, your consumption is going to increase 1 unit. So this is the marginal utility of consumption. And if you are a high type, then you're going to use deposit claims and money to acquire goods in the decentralized market. So one more unit of money will increase your consumption by 1 more unit. Okay, this is represented by this term. And there's this last term. This last term is positive, which means that if you hold 1 more unit of money, then this will decrease the probability of monitoring. So this will decrease the cost of monitoring you have to pay for the bank, right? So in other words, holding 1 more unit of money will mitigate the incentive problem in my model. Okay, that's what happens in this model. And before I talk about types of
So a quick clarification: Are money holdings private information? Or is it observable by the bank?
Money holdings are observable by the bank, and banks solve the bank's problem given the buyer's money holding because they can observe the money holding. Yes. Okay. Okay. Then in the next slide, I have different types of equilibria. But before I talk about that, we can think about what would happen when there's no payment shock. When there's no payment shock, this probability of this payment shock delta is going to be 0. So this term will go away, the last term in the left-hand side. Now that means if delta is 0, holding 1 more unit of money will be neutral to the incentive problem. And it turns out that the solution to the first order condition is not the solution to the maximization problem. What I mean is that there's a boundary solution in this case. So if mu, inflation rate, is sufficiently high, then we have this non-monetary equilibrium where money is not valued, and credit contracts provide state contingent claims. But for sufficiently low inflation rates, money is going to be valued, but credit contracts will not provide state contingent claims in that case. So I will get back to the point later again. And let me move on. So here, I'm showing the types of equilibria depending on the parameter values. So if you look at the left panel, mu is the inflation rate, gamma is the monitoring cost. So if gamma is sufficiently high, then in equilibrium, there is no monitoring regardless of the inflation rate. And what that means is that this credit contracts are not going to provide insurance role to the buyers. And if gamma is sufficiently low, there exists an equilibrium with positive probability of monitoring for sufficiently high inflation rates. Okay, so let me assume gamma is sufficiently low, and then let's look at the right panel. Okay, then there are 3 different types of equilibria. But the interesting case is that where mu is not very large and not very low. Then if mu is between mu1 and mu2, then here what happens is that equilibrium quantity of money holding does not change in response to the inflation rate. This happens because, so this M hat is the minimum level of money holdings that guarantees non-contingent deposit contracts. So if the buyer wants to reduce the money holding, then that means the buyer has to switch his or her deposit contract from non-contingent contract to state contingent one. And having state contingent contract is costly because it requires a positive probability of monitoring, and this cost of monitoring will be is something the buyer has to pay, right? So the buyer has to think about buyer has to compare the cost of holding money and the cost of monitoring at the margin, and if the inflation rate is not sufficiently high, then the cost of holding money is smaller than the cost of monitoring. So the buyer does not want to reduce the quantity of money holding. So that's why there's this happens here. And I'm going to call these 3 different types of equilibria type 1, type 2, and type 3. In type 1 equilibrium, where mu is sufficiently low, a higher inflation rate implies a smaller quantity of money and larger quantities of credit for both low and high types. So there is this substitution as in the existing literature. And monitoring cost gamma does not affect equilibrium allocations because there will be no monitoring in type 1 equilibrium. In type 3 equilibrium, a higher inflation rate implies a smaller quantity of money, smaller quantity of credit for low types, and larger quantity of credit for high types. Okay? And a higher monitoring cost implies a larger quantity of money, larger quantity of credit for low types, and a smaller quantity of credit for high types. So what I can have here is that money and credit can be interpreted as complements if you're a low type, and money and credit can be interpreted as substitutes if you're a high type. Okay. So that's a result of my paper. And let me talk about what happens in equilibrium with zero delta, meaning that there's no payment shock. So as I said earlier, if inflation rate is low, then we have a monetary equilibrium, and where money is valued, but credit arrangements are not state contingent. If mu is high, then I have this non-monetary equilibrium where money is not valued and state credit arrangements are state contingent. Okay, in my model there exists. So if delta is positive, there exists an equilibrium where both money and credit are valued and both play an insurance role, because holding money in that model mitigates the incentive problem. But that does not guarantee. So I mean, so let me look at the corollary. So corollary summarizes the result. If holding money is neutral to the incentive problem or tightens the incentive problem, then there does not exist an equilibrium where money and credit are both valued and both play an insurance role. But if holding money mitigates the incentive problem in credit contracts, then that does not necessarily mean there exists an equilibrium where money and credit are both valued and play an insurance role. So that's the result. I could use different assumptions in the model. I can experiment with different assumptions, but these are all related to this corollary. So if holding money is neutral to or tightens the incentive problem, in the end, then there does not exist an equilibrium where money and credit are both valued and play an insurance role. Okay, so let me talk about the amplification effect, because I think I have a little bit of time. So I showed you
You
the
have 5
result here.
minutes.
Yeah, thanks.
You have 5 minutes.
Okay, thanks. Here, if you look at the what happens when there's an increase in the monitoring cost, I simply tell you that there is a increase in money and increase in credit for low types and a decrease in the credit for high types. But there is actually an amplification effect because first of all, what happens is that if there is an increase in the monitoring cost, then banks will adjust their deposit contracts, specifying an increase in credit for low types and a decrease in credit for high types. But buyers know these changes in deposit contracts, so buyer changes their asset portfolios. So what they do is that they de-increase the quantity of money holdings, and this will further increase credit for low types and decrease credit for high types. So that's why there is an amplification effect of a monitoring cost or financial friction on the credit quantities, while there's no disamplification effect when you have a higher inflation rate. Okay, I think that's it. So let me conclude. This paper develops a model of money and credit financial intermediation, where a buyer's preference shock is private information, and it is costly for intermediaries to monitor. And given the setup, there is an incentive problem. So the quantity of credit for high types is constrained, while the quantity of credit for low types is larger than their first best quantity. In this model, money and credit are complements for high type buyers, and they are substitutes for high type buyers. And there is an amplification effect of monitoring costs on credit quantities. And that's it. Thank you very much for your attention.
All right, thanks. We ended early, so there's time for questions if anybody has any. If not, we can go to the break. All right, thanks Duhyeong. So we have a break now. We'll resume at 12:10 Eastern time. So we'll leave the chat open and everything if you want to ask questions.
fun though.
So I'm back recording. Thank you everyone for coming to this last day of the SaMMF Monetary Economics Conference. We are happy to have Lucie present the paper Bargaining Under Liquidity Constraints, Nash versus Kalai in the lab. You can take over. Sorry for taking 2 minutes of your talk.
No, it's fine. So hi everyone, and thank you for having me here. I'm happy to present this paper, co-authored with John Duffy from UC Irvine and Daniela, who's here in the panel. So feel free to write Q&A questions, and she may also be able to answer. Just joined the Dallas Fed. I was on job market last year, so the usual disclaimer applies. So the question of how do two agents who are self-interested decide on how to trade and how to split the gains from trade when they find themselves in a situation where there's potentially mutually beneficial outcomes is an important question in economics, and it applies to a wide variety of contexts: labor negotiations, intra-household negotiations, and then we know that in the kind of models that the new monetarist crowd works with, bargaining is often important as well. Now, typically, what's been used is either Nash bargaining since 1950 or Kalai. Yeah, Randy, you have a question? Or Kalai bargaining, also known as proportional bargaining since 1977. In a lot of contexts, actually, the solution that you use, either of these two or another one, doesn't matter too much. A lot of time will give the same outcomes. In particular, if you look at a pretty simple linear problem, it wouldn't matter. Now, if you introduce bargaining over 2 dimensions, for example, a quantity and a transfer, potentially constraints such as liquidity constraints, then the problem is not linear anymore. And in fact, the solution you use is going to matter a lot for allocations, for welfare, sometimes even for the existence of some kind of equilibrium, such as a monetary equilibrium. The bargaining weight you use on top of the solution you use matters as well. And there's papers showing how this bargaining weight can matter if you estimate the welfare cost of inflation using new monetarist models. So what we wanted to do in this experiment is to take this kind of scenario with 2-dimensional bargaining, liquidity constraints, and try and see if we could use the lab to figure out which solution seems to be more adapted or seems to be what people do in the lab, and which bargaining weight should we use.
So I don't know, this to me seems like a misguided research project. There's outcomes in the lab. We don't think people in reality are bargaining with any particular axiomatic solution. I guess you could say, it's an as if thing. They come to some particular solution. Can it be represented by a particular bargaining solution? My guess is any way of splitting the surplus, which is Pareto optimal, will correspond to Nash bargaining with some parameters, or to Kalai bargaining with some parameters. You're trying to somehow elicit information about what's the true bargaining solution. When none of them are true, they're just ways to, somehow, I don't know, think about rationalizations for what people are doing. So can you?
No, I agree with that.
You believe people are actually hardwired to do Nash or Kalai, and you're just trying to figure out which?
No, so yeah, I agree with the fact that they're doing something. We don't know the process they're using. Now, when we write a theory paper, we want to have an as if, what kind of method can we use that, at least in terms of outcomes, would seem like it's a good method, and it's not too different from what people would do in the lab, given that, yeah, we're not saying that they're doing Nash or Kalai really in a hardwire way. And in particular, Nash and Kalai do predict some types of outcomes that are pretty different in terms of behaviors when you change parameters of the environment. And I think we at least can use the lab to tease out whether those different predictions can be discarded or not. That makes sense.
Maybe.
Okay, let's see. So more precisely, what we do is that, so we have this 2-dimensional bargaining. So players decide on the side of the pie and how to split it. And we're going to use the fact that Kalai and Nash give different predictions under liquidity constraints. The bargaining is going to be semi-structured. So what we would like to do is to have the bargaining as little structured as possible. So there's no extensive form. It is structured a little bit because we do have to specify a time frame, and we specify the form that proposals are going to take, as well as disagreement values. And as I said, we want to use the lab data to estimate bargaining weights and determine whether Kalai or Nash seems to reflect better what people are doing. So there's a pretty big literature on experimental bargaining. It's been mostly focused on structured bargaining, extensive form games since 1982 after Wittgenstein alternative offer game. There's also a little bit of literature on unstructured bargaining. What really is novel is that we consider this two-dimensional problem instead of just looking at one pie that's split. That's the typical problem. And our game is going to be non-linear because of those liquidity constraints that are particularly important for monetary economies and maybe are not as important for other kind of models. Now, of course, the crowd here knows, there's a lot of papers that use bargaining and a lot of papers in which the solution you use does matter if you do use bargaining. So as you'll see, we provide support for Kalai. So here's the framework we use. So it's really taking the bargaining stage out of Lagos and Wright 2005. There's two agents, a consumer and a producer, or a buyer and a seller. The consumer gets usually U of Q by consuming Q units of the one good that's in this environment. And the consumer is endowed with M tokens. So you can think of it as what the consumer would have accumulated if it was a general equilibrium model, but here it's an endowment. Then the consumer can offer at most M tokens in exchange for Q. The producer produces Q on the spot at cost C of Q. If an exchange is agreed to, therefore the payoff for the consumer is UQ minus Y, and for the producer it's Y minus CQ. So it's a typical surplus that you would have from the bargaining stage in Lagos Wright. So in the model, the units of the good and tokens are perfectly divisible. Everything is common knowledge, U, C, M. U and C satisfy the usual assumptions. If there's disagreement, we assume that the disagreement value is 0. And again, it's because we're trying to use the same bargaining stage as in Lagos Wright. So really what's going to happen is that the choice of Q in this bargaining is going to determine the size of the pie, how much is traded, that's the total surplus, UQ minus CQ. And the choice of Y, the transfer, is going to determine how the gains from trade, the surplus, is split. So graphically, that's how the preferences and costs look like in our experiment with our parametrization. So the highest Q that would create gains from trade is Q bar here. We wanted to have an integer, make it simple. The first best quantity traded is Q star, is the quantity such that U prime of Q star is equal to C prime of Q star. We picked it to be 4. Again, we wanted something that's very simple, an integer. At the same time, we made sure that 4 is not right in the middle of 0 to Q bar. We didn't want to make it too focal. And so players can choose any transfer Y from 0 to M. So really quickly, so what we don't do in the paper, and I don't know if Randy would think that's a better question, but what we don't do is we don't test the axioms that are behind those solutions. That's another way of approaching a kind of a similar question. It's been done to some extent, but with pretty inconclusive results. So Nash and Kalai do share some axioms, but also differ. So that would be it would be possible to try and kind of see which axioms seem to hold. They're both Pareto efficient. They both satisfy irrelevance of independence of irrelevant alternatives. Nash has scale invariance, while Kalai instead swaps out scale invariance for monotonicity, meaning that if you increase the bargaining set, both players need to benefit from it. And in fact, they will benefit in proportion to their bargaining power. Okay, but again, that's not what we're going to be testing. What we're going to be doing instead is to look at the predictions in terms of allocation and surpluses that those two solutions predict and compare them with what we see in terms of allocations in the lab.
So could you go back 2 slides, please?
2 slides or 1 slide?
Yeah, there. Perfect. So, you know, a wide class of interesting mechanisms, basically all of them would draw a curve in between the 2 curves you're showing. And Kalai and Nash will be particular curves in there. So somehow could you maybe non-parametrically, by varying M, just estimate the curve that falls in between these 2 curves? And that will be considered the mechanism, as Gu and I call it, the generic mechanism. You can see if Kalai or Nash is a better fit to that potentially, or just say, well, this is our construction of the non-parametric bargaining solution.
So I guess, so what you're saying is, the way I understand it is, maybe if we were to have a graph with the surpluses, like buyer surplus and seller surplus.
Yeah.
Try and
no, not even that. You don't even need that. In Lagos, right, you just need the C and the U, and the trade will correspond to a payment in terms of money on the horizontal axis and a quantity Q in the vertical axis. So it'll be a point. I wish I could point. I'm pointing with my cursor to the graph, but people can't see that. So you'll pick up a point, yeah, in there. And as you vary the constraint, you'll construct a curve in between these 2 curves. And that will be the bargaining solution that's being used by these agents. It's the mapping from liquidity to quantities. And then you wouldn't need to have a parametric bargaining solution. This would non-parametrically give you the bargaining solution. And if you were interested in parametric solutions, you can say, what's a better fit, Nash or Kalai?
Yeah, that's a good point. So yeah, and so to some extent, I guess we are doing this a little bit in that we are getting the data that you're talking about for 3 different liquidity constraints. We could do it for more liquidity constraints.
Well, right, you're not going to get a very precise estimate with 3.
Right, so we're going to have this curve of 3 points, and then we're going to say it looks like Kalai with bargaining weight of 0.5. But I see your point that we don't have to restrict ourselves to looking at Kalai or Nash in the first place. Yeah,
so that's something for future work.
Right. Thank you. So yeah, we do kind of focus our analysis on Nash and Kalai, but it's true we don't have to. But so let me go to what we are doing for now. So what is predicted by Nash and Kalai is as follows. So we don't know the bargaining power of the buyer nor the seller if we assume there's such a thing. Let's say it's theta. That's a primitive of the environment that we don't know. If you knew this theta, you could compute M star. That's a weighted average of U of Q star, usually at the first best, and C of Q star, the cost at the first best. If the buyer has more tokens or more money than this M star amount, it turns out that in theory, Nash and Kalai coincide in form. The buyer spends M star tokens and the first best trade is achieved. So the liquidity constraint is not binding. On the other hand, if the amount of tokens that the buyer has is smaller than M star, which again depends on this bargaining power that we don't know, the liquidity constraint is going to bind. So in both Nash and Kalai predict that all of the money is going to be spent. What's going to be different is the quantity traded. Under Kalai is going to satisfy this simple weighted average, where theta K is the binding power that, let's say, the buyer would have under Kalai. Under Nash, it's also a weighted average, but the weights are a little more complicated. The weights are actually a function of the quantity traded itself, and that's the weight here. Okay, so that the weight in this equation change as M changes. And so because of this, Q is going to be different under Nash and under Kalai. And that's how we think that we can distinguish one from another. So here's kind of a similar implication. So under Kalai, the surplus of the buyer is simply this constant fixed share of total surplus equal to the buying power of the buyer. And therefore, the buyer's surplus is going to go up as you increase Q or as you expand the bargaining set. Under Nash, the consumer surplus is this share of the total surplus, big theta of Q, which is not constant. In fact, it decreases as Q increases. So it's interesting because as you increase Q, you're going to increase the size of the pie, but you're going to decrease the share of the pie that the consumer gets. So overall, it could go either way. It turns out that when Q is small enough, if you increase Q, the consumer surplus goes up. Even though the share goes down, the total goes up faster. But at some point, it reverses. Even though the total surplus goes up, the consumer share goes down faster. And therefore, the consumer actually loses surplus as the pie gets bigger. Okay, that's a big implication of Nash in this kind of model, is that the surplus of the buyer is non-monotonic. Okay, that's what we're going to be using really to tease out Nash versus Kalai. So here's an illustration, and earlier that's what I was mentioning to Randy. That's another way where we could just plot allocation in this kind of graph. So you have the seller surplus on the x-axis, the buyer surplus on the y-axis, and then the Pareto frontiers are those curvy lines here. So when m is equal to 30, that's the set of allocations you can achieve. When m is equal to 60, the set expands. And then at some point, the set is at its maximum, meaning that you can always reach the first best trade. Okay, so you can see the set expanding as you relax the constraint on money holdings. And then we drew the path predicted by theory. If theta is equal to 1/2, we just pick that. Predicted by Kalai here and predicted by Nash there. And you can see that Nash indeed gives this non-monotonic surplus to the buyer. Kalai is this straight line because the share that buyer and seller get are just constant. So the way we do it is that in each session, we have 30 rounds with 10 participants. We take the participants, we split them into 2 groups, buyers, sellers, and we make the roles fixed. We wanted to prevent them from being confused at all. So if there's any kind of learning, they would learn their role and keep at it. Now, at the beginning of each round, we matched sellers and buyers in pairs randomly and anonymously. So we were hoping that there would be no really feeling of repeated game, that they were not supposed to know who were the match with. And they were given 2 minutes to agree on the pair Q and Y. And so I'm going to explain how it works. You were able to really submit a proposal that's a pair QY at any moment during the 2 minutes, and you could write as many proposals as you wanted. Your partner could also write as many proposals as they wanted. If any of the two picked one of the proposal made by the other person in the 2 minutes, then it was done, it was over, there was an agreement. If no one did by the end of the 2 minutes, then there was a disagreement and they split with a 0 surplus.
I just have to say that this is an extensive form.
Okay, so I guess.
I mean, my theory heart bleeds when I hear there's no extensive form.
I guess, yeah, it's a continuous time extensive form. What we meant to say is there's no like discrete, alternative kind of game, but yeah, I take your point. Maybe we should be more careful.
A related question.
Yeah. Go ahead.
Have you analyzed again that extensive form? What's the equilibrium of that will look like?
No, Peter is gonna tell us. But in any case, like here, the order of moves is not really, I mean, they would decide. I guess it would be part then of the equilibrium, what kind of moves they take.
I mean, it's an extensive form. You can formalize this as an extensive form. Then it's more, well, it's more flexible than Rubinstein bargaining, but that doesn't.
They're not specifying who moves when. I mean, we're giving them.
You are specifying that at each point in time, anyone can move.
Yes, that's like yeah, that's true.
So We haven't solved it, and I think if we wanted to solve it, we would have to change a few things like the end time. Players would just, I think, want to use all these milliseconds toward the end time to bargain more and more. It's not feasible in real life. So maybe with some kind of random termination. Yeah, we could try to do that. So here, for us, that was the most we could do in terms of unstructured game. They had to give pairs. They couldn't just agree on Q first and then Y later. So in that sense, there was some structure. The way it looked like for them on their screen is that we gave them those the payoff functions. Then there were two sliders. They could move the sliders to choose Q and Y, quantity and tokens. We computed for them automatically, instantly, the payoffs for everyone in that situation. If they were satisfied with that choice, they could submit the proposal by clicking here. Now there would be a list of proposals made by each player, a little lower. And then they could accept any of the proposals that the partner had made until then. They could not withdraw a proposal. We wanted them to be kind of serious about what they were doing and think twice before submitting proposals. So they could go back and accept an earlier proposal, right? They didn't have to accept the last one. Now it's programmed in O-tree. So they earn point in each bargaining outcome. At the end of the experiment, we would draw 2 of the rounds and convert the points from these 2 rounds into dollars. We had 15 sessions for a total of 150 subjects, and the design was, the data analysis was across subjects. So now here were our 3 treatments. So we have 5 sessions with each of the 3 treatments. So in the first treatment, so remember we don't know theta, but we wanted people to be unconstrained. So we gave M high enough to make sure that whatever the bargaining power would be, people would not be constrained. And so any M over 170 would work. So we gave 315. Then we gave 2 lower treatments, 2 treatments with lower M, where whichever bargaining power would be underlying, people would still be constrained, wouldn't be able to get the first best, neither under Nash or under Kalai. So I guess that's one of the benefits of Nash of focusing on Nash and Kalai. We can compute those thresholds. Now, I think what Randy is saying is we could just do as many M's as possible. We wouldn't even know if people are constrained or not, but we could still plot the allocation. Here we know for sure that if they're playing with something that looks like Nash or Kalai, they would be for sure unconstrained in the first treatment and for sure constrained in the last 2 treatments. And so what we do is that we use the first treatment, unconstrained, to figure out this bargaining power. So if you remember, when they're unconstrained, if they're playing rationally, they should play somewhere on this Pareto frontier, trading Q star. And Nash and Kalai predict the same allocation somewhere along this line. So if we find an allocation, let's say here, we could figure out the bargaining power that's higher for the buyer than the seller. If it's here, it's higher for the seller than the buyer, right? So we can tease out theta from this first stage. Then once we have theta, we can draw the paths that correspond to Nash and Kalai for this given theta. And we can look at what we get in the lab and see which path is closer to our data. Okay, so that's our two steps that we're following.
Sorry, Lucie. I have a question, but I also have to tell you that I have 5 minutes. Is there an assumption that the bargaining across agents it stays constant?
The bargaining weight, you mean?
Yeah.
Yeah. So we do assume that the bargaining weight is not agent specific, but more situation specific for buyers and for sellers. Yeah. Mm-hmm. Okay, so I have 5 minutes. So here's what we're doing. So first, we wanted to check 2 hypotheses that have to do with checking that players understood the game and players are playing rationally and playing consistently to both Nash and Kalai, right? So hypothesis 1 is saying that they should achieve the first best in the constraint case. Hypothesis 2 is saying that if you increase M, so you're relaxing the constraint, they should trade more Q, the transfer should be higher, total surplus should be increasing as well, and the seller surplus should increase. Okay, all of this is consistent both with Nash and Kalai. We want to make sure that at least this is right. The next 2 hypotheses are about teasing out one from the other. there's different ways we could do it. What we thought would be the most interesting and convincing was to look at this non-monotonicity, look at the buyer surplus and see whether it's monotonic like Kalai predicts or non-monotonic like Nash predicts. So first we can check very easily that in the unconstrained case, subjects achieve the first best. On average, they play very close to a quantity of 4, so that was good news. People understood the game and they were playing it well. So once we knew that, then we could estimate the buyer surplus. We know they're somewhere on this linear, on this line, on this Pareto frontier. Where are they? So we regressed buyer surplus equal to theta, the share of total surplus plus some error. Now I won't go into the specifics, but we use different samples to make sure that this is robust. In any case, we always find a share that's roughly 0.5. Okay, so it seems like they were sharing the surplus equally when they were unconstrained. And this allows us to derive a bargaining power of 0.5. Once we have this bargaining power, then we can look at the allocations when M is smaller to try and see whether it looks like Nash or Kalai. But first, we wanted to see that people still play rationally. So quickly, we can look at the right panel. It shows it's an overlay of the data we get on top of the predictions that I showed you earlier. So we still have the 3 Pareto frontiers, and then we have the allocations for the 3 treatments. In red is the lowest M, in orange is the middle M, and then in green is the high M. So a large majority of all of the agreements still are on the Pareto frontiers, meaning that people were still playing rationally. And you can check actually that if you look at tokens traded on the left panel, those are the distributions. Again, when people were constrained, they were very close to spending all of their tokens. So they understood that they shouldn't be negotiating on the transfer. They should be negotiating on the quantity, right? They should give all of the money and then negotiate with Q. So they were doing that so they got it. So they were playing the game against correctly. Now, in terms of Nash versus Kalai, we cannot distinguish from here because both Nash and Kalai have the same predictions for tokens. But for the quantities, you can look at here. The dashed line is the prediction by Nash, and the dotted one is the prediction by Kalai. The full line is what we actually get on average. And every time you can see that it's much closer to Kalai than to Nash. Nash always overestimates how much should be traded by a large margin. Another way to kind of look at the same thing is what I said earlier, looking at the surpluses of the buyer and the seller as you increase the M. So you have the 3 bars here showing the surpluses. You can see it increases exactly like Kalai would predict, and we don't get at all a notion of non-monotonicity. So maybe to kind of go back to what Randy said earlier, we don't have to say it's Kalai, but I think it's pretty clear that there's at least one thing that Nash predicts that we don't see at all in the data. So,
well, I have to say this. I think your idea for the paper is not very good. I think your results are amazingly good. If you had made up this graph, previous graph, you could not have made it look better for what you're. This is hugely, strongly suggestive that Kalai fits better, and it fits very well.
Mm-hmm.
Kind of amazing.
You mean the one on the left or the one on the right?
Everything.
Well, that's
I would
good.
assume you get total noise out of the experiments, but you don't. You get something that looks pretty good in terms of the theory, and it clearly distinguishes between Nash and Kalai and says Kalai is a better fit.
Mm-hmm.
But I think Iju has a good point. What if the equilibrium of this game looks like Kalai bargaining?
What's the point about that?
Well, so then the point is that, well, so we're looking at a game which is not going to give you, which is predicted by theory to give you something that looks like Kalai bargaining. I'm not saying we know that's the case because we don't. But,
I mean, basically, already there is not much in terms of non-cooperative foundations of Kalai. I guess Guillaume, Lucie, Taiwei, right? They have some work on that. And definitely they have more structure than we do. right? Because other than the time limit, we don't give them, like, I'm not sure, Peter, what would you consider an unstructured game then? Not giving the time limit that you would consider not being an extent? I mean, what would you consider not an extensive game?
I'm not
There is the
arguing-
notion of unstructured game, right, in game theory. What would you consider if you don't consider hours? What would you?
I was just taking offense that you call that a game without an extensive form. And then how structured or unstructured it is, that's, I guess, I agree that you have lots of flexibility in your extensive form. I was just complaining about your wording.
So I think we could try to solve for, I think there's no reason to believe it would be Kalai would be the equilibrium, but I don't have a reason to say it's not either. So I take the point. Just 30 seconds to say really quickly. Randy said that the data fits well. Now I think a common reaction could be to say, well, Kalai with 50-50 works well, but what if people are just trying to inherently that they like to have equal split? It's not that they're doing Kalai or anything. People just are used to splitting equally. I think we do have some data that in my opinion, goes against this idea, in that people really try to negotiate and they're really bargaining in that they try to get better terms of trade for themselves initially. And negotiations are kind of long. On average is 7 offers. And when people don't agree, there's more than 11 offers back and forth. And people make their first offers much higher, as you can see on this graph here, than the eventual agreement. So they do try to get more for themselves. So maybe they do agree on equal split in the end, but I don't think it's just a fairness loving attitude. All right, so I'll just leave my conclusion slide here, and I'm happy to answer questions in the chat later. Thank you.
That's important. You know, most strategic models, which sometimes can rationalize a particular axiomatic model, have the game end at the first round, right? There is, I mean, it's one of these ironic things. There is no bargaining in bargaining models. There's an offer and it's accepted, except for some, not extreme, but complicated private information versions where you're trying to elicit information. Maybe that's what's going on here. But your guys are taking a while to make offers and counter offers. They're actually haggling. They ultimately settle, and it turns out it looks like Kalai, but I don't think any of the standard strategic bargaining models are going to get several rounds of offers and counter offers. It's an equilibrium outcome. That's pretty interesting.
Thank you, Randy. Thank you.
There is no cost of delay, right?
Isn't there? Oh,
I don't think so.
Because being that at some point you just have a
delay in there. The easiest way to do it is after each round or after each offer or whatever, there's some probability of the match breaking up.
right.
You don't want to put discounting in there, I don't think, because you don't want to believe there's a long period of time during which the negotiations take place. But you might want to say the longer it takes to settle, the greater the probability of a breakdown.
Mm-hmm. Yeah, we could do that.
I think another thing you could try is that you could sort of have different outside options to check for the focality.
Right. Yeah. Mm-hmm. I mean, in theory, it shouldn't matter, but it's just think in terms of surpluses.
Right.
But it could matter in practice.
Yeah, thank you, Lucie. We are happy to have you now presenting his paper, Panics and Prices, with Vijay Krishna. Thank you. You can take over. Yeah. Okay.
Yeah. Okay. Now, can you hear me? Okay.
Yes.
Great. So thank you very much for having me here. I'm especially thankful because this paper has a strong New Keynesian flavor. So this
What?
paper is
The new Keynesian paper?
no, some flavor. You will
I
see.
have a bad taste in my mouth already.
Okay, so last year we saw a lot of panic buying, right? In particular, like even in Japan, where we have Toto, still they are crazy about toilet papers. The common explanation is by something like this. So there are idiots who believes that there's shortage, and these idiots are rushed to buy. And then, even if you know that there's no problem on supply, they still have to buy because they are idiots. And this go so on and so forth, right? So this explanation rests on complementarity of choices, right? So if more people buy today, then it's better to rush. So if others do something, then I have to do the same kind of action. Now, this explanation is of course reasonable, but in the if you open some textbook undergrad, there's some important thing that is missing here, right? Which is price. So if a lot of people buy today, then today's price should rise. And so this makes it more expensive to buy today, right? So because of this price, the consumer's choice no longer have complementarity, right? If a lot of people buy, then today's price rise, and so it's not a good idea to buy today. So here the big question that we ask in this paper is, can the price mechanism prevent panic buying? And if not, then maybe price control may be better. That's what we are going to do in this paper. And here's the finding. So with flexible price, so if price is determined in the supply and demand, then there's always a panic equilibrium. Panic cannot be prevented. If the normal supply, you will see what normal supply exactly means. But if the supply in the normal state is not too large, then the equilibrium is unique. So this kind of flexible price cannot prevent panic buying. On the other hand, if we fix price, and we are not asking why price is sticky here. If government just determines price and it has to be fixed at certain level, then there's no panic equilibrium under some conditions. And so in these conditions, the flexible price cannot prevent panic buying, while fixed price can. And we saw that in this kind of parameters, the usual welfare comparison says that as you can imagine, fixed price is better in terms of welfare, both consumer surplus and producer surplus. Makes sense? So that's what we do in this paper. So I heard that some new Keynesian model says fixed price is better. So and or the degree of stickiness is some lower degree of stickiness is better. And in this sense, this paper has some new Keynesian flavor.
I would say that if the stickiness is endogenous, it's not new Keynesian.
Oh, I see. Okay, that's good.
Two things.
Yeah.
Not nominal stickiness, it's real stickiness, obviously.
Mhm.
So it's not Keynesian in that sense. They're all about nominal stickiness.
Ah, I see.
Real stickiness could emerge from things like government regulation. You know, when Lebeau's job market paper was about taxis, he didn't have prices in the model. Why? Because prices are not endogenous, they're set by government regulators. So it could be a good, interesting analysis of prices being set somehow exogenously or by institutions other than a Walrasian auctioneer. I would not go too far into this Keynesian thing. Well, I guess depends what your motive is, but anyway, it seems
Okay,
interesting. But it is real, not nominal rigidities that matter here, which is distinctly non.
I see. Okay, thanks. Okay, so let me proceed. So first, in this talk, I will show the model, and then I will talk about non-supply case, and then uncertain supply case. And I will focus on this non-supply case, where of course this means supply is known, because the main idea can be conveyed with this non-supply case. The uncertain supply case I have something to say, but it will be very short. Here's the plan. Okay, so let's see the model. So here's demand side, continuum of consumers, which I believe there's no problem for this crowd, but there's continuum of consumers. They consume at most 1 unit tomorrow, the storable good. And in period 1, each consumer gets some estimate VI from a distribution on 0, 1. In period 2, final value is determined. With probability lambda, the WI is VI, and with the other probability, WI is they get new draw. This draw is independent from today's estimate in this event. So, and while consumption takes place only tomorrow, each consumer has an option to buy today. The today's willingness to pay is lambda times VI plus 1 minus lambda EW, right? And tomorrow, if you buy tomorrow, then you know your consumption value WI. So willingness to pay tomorrow is WI. Make sense? Here is supply side. So there's total supply theta of raw material, and this can be converted to good 1 for 1 at some unit cost C. Okay. And in the later section, we consider there's some uncertainty on supply, but let's stay with the case where the supply is just theta, and this is common knowledge.
So can I ask a question?
Sure.
In the second period, is there again a market or?
Yes, there's a market.
So
I will come to the market.
If I buy and then I learn my valuation, can I resell?
No, resale is prohibited.
Okay.
Yeah,
So, Ricardo, you should be thinking of his leading example of toilet paper.
Yeah.
I mean, you resell the unused, I mean.
Oh, I thought you
Yeah.
Yeah, resale causes some complication, but I agree. It's kind of less Amazon, of course. On the other hand, Amazon tries to ban such resale. So, anyways, in our model, resale is not allowed. We consider some small case how the allowing resale changes the result. But anyway, so throughout the paper, we assume this assumption, which just says there's gains from trade today. So the marginal cost of producing the good is C, and the expected value of consuming today is at least this one. So there's gains from trade today for everyone, every consumer. And here's the assumption on the market. So trade occurs today and tomorrow. And sellers cannot turn away consumers' willing to pay current price by law or something. So if you open if you look at some legal thing in Japan or US, there are some anti-holding laws, and we are assuming this too. So yeah, that's one big assumption we made. Sellers are not, in some sense, sellers are not strategic. Consumers can determine when to buy, but sellers cannot determine when to sell.
That's crucial, right?
Yes, it is.
I mean, in the toilet paper, the stores were putting themselves somehow quantity constraints, right? You could not buy more than so many rolls at some point.
Yeah.
So that's something that's just, it's not a decision the seller can make here. Is that right?
Right.
Okay.
Exactly. Yeah. So, and in
I guess Todd, maybe Todd can talk a little bit more about it, but like this is like you're not allowed suspension in Diamond Divot, right? Like it's
yeah, I think the counterpart of Diamond Divot is no suspension. I think so.
Maybe we should do something with commitment, like.
Okay, so anyway, this is what we are in the model, and in each period, prices are competitively determined, and we compare this to the case where price is fixed. So by this, what we mean is just it's just demand and supply, undergrad textbook. Okay. Plus, the key friction is here is that there's no allowable securities to ensure preference shocks. So it's not like there's no allowable kind of thing that if my value for toilet paper is high tomorrow, then I want to buy, and otherwise I won't buy. This kind of thing is not allowed in our economy. This is the key friction.
So could it be optimal or welfare improving to make the market today less liquid? Say it opens
Yes.
only with some probability.
If that probability is zero, then that's the best.
Oh, I see.
Okay, so here's the model, very simple model with the two-period model. Okay. Now let me get into the analysis with the flexible price. Okay. First, we show the following lemma, which is says if more consumers buy today, then prices in both periods are higher. This is what this lemma says. So, of course, if a lot of people want to buy today, then it, of course, increases today's price. But it also affects tomorrow's price. And in particular, that kind of panic behavior raises tomorrow's price as well. That's what this lemma says. And first, from here, this already gives some good hint at why we get the result, right? The flexible price cannot prevent panic, because if panic occurs today, then it of course increases the cost of joining panic, as undergrad textbook says. But also it increases the cost of waiting. So this is a hint at why we get the result. And because this lemma is central to the result, and Narayana Kochirakotta said that one has to show at least one proof in a talk. So let me follow his advice. So here is the proof. So this is usual demand curve and supply curve. So y-axis is price, x-axis is the demand and supply quantity. Okay. This this blue thing is that when some consumers buy today, and blue is the case where more consumers buy today, and this is the demand and supply curve tomorrow. Make sense? So green is the less consumers buy today, blue is more consumers buy both today. Okay. So first these two horizontal, vertical ones are the supply curve. Supply is just residual. This doesn't respond to price. These ones are demand curves. So first note that when price is 1, then of course nobody wants to buy, right? And if the demand is, price is 0, then everyone who didn't buy wants to buy tomorrow. Make sense? Right? And so when price is 0, the difference of supply is the same as the difference in demand. So the length of S2 minus S2 bar, the residual tomorrow, residuals less consumers bought today minus more consumers bought today, it's the same as the demand difference. Make sense? And so here the difference is 0. Here the difference is S2 minus S2 bar. So for any intermediate price, this length is less than this demand difference. Okay. So then if market clearing price is here, and when price is P2, and if the same price when more consumers buy, then there's more demand than supply. So that means price has to increase. this is why we get this lemma. Okay, so far makes sense. Okay. So then, because we have the second result, which is the failure of strategic complementarity. So we get this kind of thing, which shows the failure of complementarity. So this means that this y-axis is when sorry, the differences of payoffs of buying today versus buying tomorrow. This y-axis is roughly means how many consumers buy today. Then this one means everyone waits, and this zero means everyone buys today, tries to buy today. Then the incentive to buy today and versus tomorrow is not monotonic, as this graph suggests. So when too many people want to buy today in this range, then the good is sold out tomorrow. So tomorrow's price, in other words, tomorrow's price is 1. So if you wait, then you can get nothing tomorrow. So here, the incentive to buy today is high. And then if less consumers buy today, then today's price is just C, right? The marginal cost to produce the good. And tomorrow there's some trade occurs. So if this is the time where you want to you have the strongest incentive to buy today. So if there's some small the excess supply today, because some intermediate number of consumers buy today, in that case, today's price is C, cheap, and tomorrow's price is high. So this is this intermediate case is a case where the one has the strongest incentive to buy today. Okay, so that's why we don't have complementarity, as kind of our intuition suggests. Okay, so far makes sense. Okay, using these, we show these 3 results. First, for all theta, so note that this theta is always less than 1, and 1 is the measure of consumers. For all theta, there is a rushing equilibrium where everyone tries to buy today. The reasons are kind of simple. So if all rush, then today's prices are just this one. So today's prices are the market clearing price. In this case, market clears in the first period today, and tomorrow you have no chance to buy. So then if you wait tomorrow, then there's no, your payoff is 0. If today's payoff is high, then you have a point of buying today. Make sense? So this is kind of the weakness of market clearing price. Market clearing price doesn't go above the market clearing price. That's why it cannot prevent panic buying. Of course, this may sound tautology, but this is what it means. Second result is that when theta supply is small, then rushing is the unique equilibrium. Okay. The reason is that if everyone waits, then today's price is C, and tomorrow's prices are tomorrow's market clearing price. But because supply is small, right? Tomorrow's supply is small. Tomorrow's price is high, right? That means it is better to buy today. In this case, that's this second result. Reason of this second result. Lastly, when theta is large, then there's another equilibrium where everyone waits. the reasons are the same as this one. So now today's price is C, but tomorrow's price is not so high. Even if everyone waits, there's plenty of supply. So tomorrow's market clearing price is not that high. Make sense?
Can I ask a question about
Sure.
the first rushing equilibrium?
Sure.
So it seems to me that should we go to the second period, then the price is going to be higher, right?
Tomorrow's price is 1 if in this rushing equilibrium. There's no good left.
Right, but I mean, if I should say that we had a little bit left next period, then the price would go up in the next period, right?
Yes.
So why, I mean, if you think about competition as Bertrand, why not sort of value the price in the good in period 1 as the value it would take when you go to the second period? Wouldn't that be a Bertrand equilibrium? I mean, deviating from that seems to be a bad idea.
Sorry, I didn't understand. Today's price is just this amount, right?
Let's just do the counterfactual. Let's all wait to the next period, figure out what the price would be in the next period.
Yeah.
Then if all sellers would price at that second period, that sort of hypothetical second period price.
I see. But
wouldn't that be sort of the natural sort of competitive equilibrium?
In our setting, sellers are not allowed to not to sell.
But they are allowed to, I mean, if you think of it as Bertrand, they should be allowed to charge different prices, right?
Here we are concentrating on the market clearing price, the one undergrad textbook and demand and supply.
All right.
Maybe let's talk later. Maybe if this doesn't answer your question. Okay. So it's just a market clearing price, and so the P1 is this thing, and it doesn't go rise above this amount. Market clearing price doesn't go above the market clearing price. So that's why today's good will be exhausted if everyone tries to buy today. Okay. So here's our main proposition. And the one thing we show is that the cutoff for these two, the cutoff theta is the same. So there's some theta star below which there's a weighting equilibrium. And if above this, above this cutoff, there's a weighting equilibrium. And with the same cutoff, the buying today is the unique equilibrium. So because of these things, the flexible price cannot prevent panic buying. Okay. Oh, looks like I have 5. Okay, let me say this fixed price. So prices are fixed at normal level, at this level, which is the market clearing price when the everyone waits. This is what we mean by fixed price. So in this case, if everyone tries to buy today, then we have to have rationing, right? If everyone wants to buy today, then there may be some rationing has to occur. In this case, we have the following 3 results. So for all theta, there is a weighting equilibrium. This means that if all wait, then it is best for me to wait to see the option value. So remember, today's value is I just have some estimate, and tomorrow if I wait, I know the my consumption value perfectly. So if prices are the same and the probability of buying the probability that I can get the good is also the same, then I strictly want to wait. And this is what happened for all theta. If everyone waits, then the today, if I try to buy today, I can get the good for sure, but tomorrow I can get the good for sure too. So, and the prices are the same, so no point of rushing for me. Next, if theta is large, there is plenty of supply, then there's also a rushing equilibrium. The reason is just today's price is low. So if everyone else tries to buy today, then again, by the same reason, tomorrow I cannot buy. So I have to join. When theta is small, the supply is small, then waiting with the unique equilibrium. Because the market, that is just because the price today and tomorrow are both high, because the supply is small. So I don't want to gamble. I don't want to buy without knowing my realized value. So here are these cutoffs are different, but in one figure we get something like this. So this is when flexible, and this x-axis is theta, the supply. This green means that everyone waits. Sorry, everyone buys today. This is rushing equilibrium. Everyone buys. And this orange is the everyone waits. So for flexible, for all theta, there is an equilibrium where everyone buys. And when theta is enough, there's another equilibrium where everyone waits. And fixed, somehow it's opposite. So for all theta, then everyone waiting with an equilibrium. And for theta big enough, there's another equilibrium too. So in other words, when theta is big enough, then in both regimes, both are possible. When theta is small, then in both regimes, equilibrium is unique in both regimes, but the features are completely opposite. Bruno, how much more time do I have? Maybe 1 minute?
Sorry, you can have 2 minutes because you start 5 minutes late. Yeah.
Okay, good. So I think this is the central channel for our result. But in the paper, we also consider a case where the panic is caused by rumors, and we get the unique equilibrium. So here there's some very interesting fact in Japan that panic buying is triggered by counter rumors. So there are some people who say that there's shortage of toilet papers, but these tweets are really small and didn't get almost no retweets. Now, then some people said that there is some fake news that says there are so many, there are shortages. And this is the source of panic buying. So this is retweeted really a lot. And everyone, not everyone of course, but a lot of people in Twitter see this kind of news. The news is that there is a fake news that says there are shortages. And this, after observing this, the panic buying occurs. Panic buying occurred. Makes sense? So this is an interesting stylized fact. And in the paper, we incorporate this feature to generate in a way close to Rubinstein email game and to show that uniqueness. So with this, we show uniqueness. There is some technical difficulty that this is not immediate application of proof is not immediate application of Rubinstein email game, but we show uniqueness using that kind of method. Let me just mention that why even though there is some, sorry, this is when price is flexible. So the reason that this iterated elimination of dominated strategy still works here is that despite the price is flexible, is because of the first lemma I show. So some people who get some wrong fake news tries to buy today, this increases cost of buying today. Not, of course, this increases cost of buying today, but it also increases cost of waiting. And so those who get the corrective messages, those who know that the shortages are fake news also have to buy, because they understand that tomorrow's prices are also high and cost of waiting is high. That's why despite there's price mechanism and we don't have strategic complementarity, still the iterated elimination of dominated strategy works. Okay, so I guess quite naturally, we get the welfare comparison as well. So the fixed price gives high with waiting gives higher payoff, higher welfare to both consumer side and producer side. Okay,
Thank
so
Sorry.
no, maybe that's all I wanted to say.
Thank you. We can start, we can chat for another 3 minutes, so go grab a coffee and then we'll be back with Todd Keister. Okay, thank you.
Okay, thank you very much. I'm now more comfortable that seeing that this is not a new Keynesian work.
Well, you know what? Somebody mentioned this already, but to me, it reminds me of nothing as much as the bank run literature. Diamond Dig, things like that.
So there are true that there's today and tomorrow, but I didn't see more than that. In particular, the natural contact.
If you think other people are going to run on the bank, then you might want to run on the bank too. It's like the idea, if you think other people are going to go and buy up all the toilet paper, then you want to buy the toilet paper too. That's what I mean, they're related.
I see. But here, because of price, we don't have we may not have that kind of thing from the first place.
Well, no, I'm not saying it's a special case or anything or identical to that literature. I'm saying some of the same issues are discussed in that literature. The literature also goes to elaborate lengths to try to construct, complicated mechanisms that may prevent runs. Like even sometimes using mechanisms which are not direct mechanisms, because they're not only interested in getting something to be in equilibrium, but ruling out other things that aren't equilibria, so the revelation principle may not be relevant. So anyway, there's a huge literature on this bank run phenomenon. Many of the papers are terrible. There's a few which are really very good. And it's related in the sense that, consumer sentiment or whatever could generate some kind of behavior, which might be a self-fulfilling prophecy. I mean, probably to your worthwhile to make a connection to that literature, either say this is related or say it's not related. But I think many people will notice that there's at least a superficial similarity to the bank run literature.
Yeah, I was kind of going to say the same thing, that it would be helpful for me and maybe for others as well, if you tried to translate this into a Diamond and Diffie model, and maybe as a banking model, it'll look weird, like, because you'd want the bank to somehow replicate the pricing here.
Yeah, I think so.
But if you tried to do that, what would it look like, and what would we learn? How would that help me understand your environment better? Maybe.
So first, the fixed price is somehow closer to the, for example, Goldstein, the type of rationing thing for the early first come first serve, and then and the bank has to fulfill the contract, and if one bank cannot have pay, then it cannot do more than that. Right?
So can I interject here on the banking literature? I think a better parallel would be the work by Franklin Allen and Gary Gorton, because they do have these constraints on how much you can you can withdraw in total. So I think that model is way more close to this model, and it also has endogenous prices in some sense, I guess.
Oh, how?
I mean, there are differences in returns. I forgot exactly how it works, but,
I will have a look.
but I think that model is really close to what you're doing.
Thanks. I will have a look at that paper. Still,
Thank you.
yeah, thanks.
Oh, sorry. Yeah, thank you. Thank you, everyone. This was a great conference, and I'm happy to have our last speaker, Todd Keister. And yeah, please take over, Todd. And we're very happy to have you give the keynote of today.
Okay, is that showing properly?
Yes.
Yep. Okay, great. Well, thanks very much for having me. So what I wanted to do today is here. I'm going to try and give a slightly broader talk since it was labeled Keynote, which I assume was some sort of clerical error, but I said, okay, I'll take it. But a lot of what I'm going to say is based on this joint work with Daniel Sanchez, who is here. And so you can ask questions in the chat, and Daniel may try to answer them, but I'm also going to give some more speculative thoughts that Daniel may want to disassociate himself from. Okay. So obviously, I'm going to talk in a sense about the same issue that Harold talked about yesterday, digital currencies, but I'm going to take a very different approach. I'm going to be much more narrow. I'm only going to talk about central bank digital currencies for the most part. And I only want to focus on, Harold showed, he gave this broad overview and talked about a bunch of different things. There are a lot of interesting issues. I just want to focus on one particular issue, the potential role or the desirability of a central bank digital currency. And I want to address it from one angle, from what I'm going to call a monetary theory perspective, that is focusing on the role of central bank digital currency as a form of outside money. So as I said, the ideas are based on the paper with Daniel. Many of you I know have seen the paper with Daniel before. On the title page, I meant to give a plug. If you've seen it before, we have a new version that we just finally finished revising last month. It's much better. Please go take another look. I'll talk about some of the new results, but I'm going to try and put everything in a broader context here. Okay, so yesterday, in Harold's talk, Ricardo asked, so what is the problem that a central bank digital currency will potentially solve, right? And my answer, I think is the same as what Harold said. And when you read the policy discussion, it's not so clear. People talk about a lot of different things. A lot of the comments are related to market power in the banking system or to perceived shortcomings of the current banking arrangements, like the under-provision of services to some particular communities. There's also very clear this concern about potential future developments with Facebook's Libra now Diem proposal. But there are also some other comments in the policy discussion along the lines of, it's important for the public sector to be involved in providing money. And sometimes it's not completely clear what that means. But that's the angle I want to take, and I want to try to think through. So why would it be important for the public sector to be involved in providing money? Let me start with a super simple model. So what I'm going to do is set up a super simple model without CBDC. Then we're going to use it to talk about CBDC, and then we're going to talk about some other interesting topics. Okay, so call this a baseline model. So this is going to be a simple model with only inside money. In the Lagos Right tradition, you can think of it as kind of a simple version, maybe of Lagos and Rocheteau, for example. And since I'm not presenting a paper, I'm going to be a bit loose on the assumptions, but think of all of the normal assumptions, right? So time's discrete, there's a centralized market, a decentralized market. There are buyers and sellers, and they're just going to be completely standard, a textbook version of the model. They're going to be randomly matched in the decentralized market, no bilateral credit for the usual reasons. And for now, all the buyers are identical, the sellers are identical, and each DM meeting that occurs is identical. All right, and in this baseline model, let me think there's no currency, and the only medium of exchange is this claim that I'm going to label bank deposits. This is going to be issued by another type of agent, which is good. That these agents are going to be a combination of a banker and a firm, and it's going to be backed by real investment. And it has, by assumption, all the properties you need for it to circulate as a medium of exchange. Okay, so let me talk about these banker firms. So here now, there are different ways of doing this. Here's the way Daniel and I did it in our paper. Yeah, go ahead.
So one view is the banks are holding on to currency and you're paying with claims on the currency, which is effectively the same as paying with currency. Another view is banks are issuing somehow claims on themselves, which can be used as a payment instrument independent of currency. Which view do you?
Yeah, exactly. So I'm going to come back to exactly that point, and that distinction is going to be important. So here it's claims on themselves. This is what I'm going to talk about on the next slide. What I mean by these claims have to be backed by real investment. All right. So here's a version of it. So each of these bankers has access to a single productive project. To keep it simple, it's a fixed indivisible thing. You put in 1 unit of the centralized market good in this period, and you generate some output gamma J for banker J in next period's centralized market. We're going to have that be heterogeneous. But there's no uncertainty here, but there's heterogeneity. So some bankers are super productive, some bankers are not so productive. So here gamma, think of this as the distribution of bankers across gammas. This is the most productive guy. There's some unproductive guys. Right, and so this is just one way of generating diminishing returns to aggregate investment. As more and more stuff gets invested in the economy, the marginal banker is less and less productive. Now back to Randy's point in the deposit. So the banker is going to have no endowment. They can borrow by issuing deposits. And what is a deposit? It's going to be a claim redeemable for CM consumption next period. The deposit market's going to be competitive, so there's going to be some interest rate. Remember, they're borrowing 1 unit, so they have to be able to repay 1 plus RD. And they need the income from their project. This is their only source of income, so the only way they can repay is if the income a particular banker J has from his project next period is enough to repay the loan. So implicitly here, it's for the moment, and I'm going to change this, but for the moment, think of that future income is fully pledgeable, can be used to collateralize the deposit if you like. And this is the only type of claim that bankers are credibly able to issue in this simple model. Okay, so that's the environment. Again, this simple baseline environment. So what's an equilibrium? I mean, this is all straightforward. So buyers have some demand for deposits, and this is completely standard. Assume their preferences are such that their real demand for deposits is an increasing function of the interest rate on deposits. It's going to become vertical at 1 over beta because of the quasi-linear preferences. And then these bankers collectively are going to generate a supply of deposits. And the supply of deposits, this red curve is just, at any given interest rate, what is the measure of bankers who can satisfy the repayment condition, the measure of bankers whose productivity is enough that they're able to generate enough income tomorrow to pay that deposit rate. Okay, and obviously the higher the deposit rate is, the fewer bankers that are going to meet that generates the downward sloping supply curve. All right, so in equilibrium, again, this is all very standard. There are going to be 2 cases depending on where that supply curve lies. If there are, I'll call this the case where high return projects are plentiful, or there are just a lot of bankers with high values of gamma J, the supply curve is going to be kind of high up on the graph, and it's going to intersect the demand curve at an interest rate of 1 over beta. Right, so then the equilibrium interest rate on deposits is the same as the interest rate that would apply to a fictitious illiquid bond. Because the interest rate on deposits high, buyers hold a large quantity of deposits. Because they're holding a large quantity of deposits, we'll get the efficient level of trade in DM meetings. I haven't defined it, but you know what Q star is. And so the allocation is going to be great, fine, first best. The other case is where now the only change here is imagine we just shift down the productivity distribution of bankers, right? So high return projects, there are just fewer bankers, say at each level of productivity. That means the supply curve shifts down. If you do that enough, the intersection occurs on the upward sloping part of the demand curve. So the equilibrium deposit rate's less than 1 over beta, liquidity premium. Because the interest rate on deposits is lower, buyers economize on deposits, they hold less. Because they're economizing on deposits, there's inefficiently low trade in DM meetings. And notice, it's not in the graph here, but notice there's also then going to be overinvestment in the centralized market. That is, some projects that are not socially efficient, that have a return below 1/beta, are going to end up being funded because of the low interest rate. And why is that? They're useful because they're a way of creating liquid assets for the buyers. All right, so take that simple model as sort of a baseline. And if we look at this ladder economy, we're going to focus on the latter case, and you say, okay, is there a problem here? You could say, well, there seem to be some inefficiencies. And what is the problem? The problem is that the private sector's ability in this environment to create money or media of exchange is limited. It's limited by the set of productive projects available. And if there aren't enough productive projects available, that's going to create these issues. All right, so if we think of that as a problem, you ask, well, is there a solution? Well, one way to address that problem is to introduce outside money. Right, so now let's introduce to the environment the central bank. The central bank can issue physical currency, and it has all of the usual properties. Think of the central bank as setting the growth rate on the money supply. The gross growth rate is going to be mu, but I'm only going to talk about stationary monetary equilibria. So you can just as well think about the central bank setting the inflation rate. And that something's going on in the background. So imagine the central bank's balancing the budget each period with lump sum taxes or transfers. Okay. So if I say now this is possible, this is in the environment, the central bank could do this, and I ask you what's the optimal policy? Well, you're going to say, well, that's easy. In this setting, you want to run the Friedman rule. That is, set the growth rate, the gross growth rate to beta. So the rate of return on holding money is 1/beta. What happens when you do that? Well, when agents have the option to hold currency and earn 1/beta, that means the interest rate on deposits has to rise up to 1/beta, right? Because liquid assets now high, so the liquidity premium disappears. Because the liquidity premium disappears, buyers are going to hold more total money balances, right? If add together their inside and outside money holdings, because they're holding higher total money balances, you get the efficient level of DM trade.
So Todd?
Yeah.
Yeah,
Go
so
ahead,
I was gonna say it's like so you got lots of models where that kind of want an outside asset. So you can have this kind of overcapitalization phenomenon, and you solve it with the outside asset. Well, here it's like you could solve it with government debt that the hold, right? Rather than issuing currency.
That's absolutely right. And so and I'm going to come back to this later and kind of talk about narrow banks. Is there a difference between central bank digital currency and narrow banks holding government bonds? From everything I said so far, there'd be no difference. I'll talk about one difference later, and this is going to be related to your paper. But that's absolutely right. So I'm talking about outside money. What really is important is that there is an outside asset that can be directly or indirectly used as a medium of exchange. Okay, and with that caveat, again, I just want to emphasize everything here is kind of standard, right? The inefficient, so as Steve said, but I just want to emphasize, so when the liquidity premium disappears, the overinvestment disappears with it, right? There were these inefficient projects that were being funded as a way of creating more inside money. Now that doesn't happen. And the equilibrium allocation now becomes first best. So it's like all of the problems are solved here. Okay. So again, summary of this simple baseline model. Why might it be important for the public sector to be involved in providing money? This is one view, right? One answer is, in some environments, having outside money or an outside asset that can be used as money, it's a way of increasing the stock of liquid assets. And that's helpful. It lowers liquidity premium, leads to higher DM trade. Notice, and again, I'm just repeating this, but I want to emphasize it, outside money crowds out inside money in the process of doing this, right? And it does that by lowering the liquidity premium. and that's raising the interest rate that bankers face when they borrow. But that disintermediation here is a good thing, right? It increases net output in the centralized market. It's truly inefficient projects that are being crowded out. Now, I just want to make a remark outside of this model that I'll come back to at the end. So here we get, outside money is sort of unambiguously good. And part of the good thing it's doing is it's crowding out low return projects. In a broader setting with risk, you could imagine potentially that outside money would also crowd out low quality assets in another sense. That is, it might reduce the production of low quality, seemingly safe assets that are not so safe, and therefore also improve financial stability. So think of mortgage-backed securities that are being used in some sorts of transactions. Maybe there's a role for outside money to crowd those out as well. Okay, this is a highly speculative thing. People talk about this. I don't know of any great models of this, but I'll come back and mention it again at the end. So that's why the star is here. All right, so what about CBDC? So let me think first about, I don't know about this word digital, but let's just talk about electronic money. So in the model I just gave you, it says, if there's a shortage, if the private sector is limited in its ability to create inside money, physical currency, if it can be used in these transactions, is one way of solving the problem. But of course, physical currency is difficult to use in many settings. If we're talking about large values or transactions where the parties are at a distance. So if you think of those DM meetings in the model as being something where physical currency is just not practical, well, then if you want to get the benefits we just talked about, you need some form of electronic outside money, something that can be used similarly to bank deposits. Right, so there's one potential rationale for a central bank digital currency. It's just providing outside money, which is useful for the reasons we just discussed, that can be used in more situations. In situations where currently outside money, there just isn't a form of outside money we can use. In the model I gave you, it's trivial, just relabel currency with central bank digital currency and say now that's the type of medium of exchange that can be used in those DM meetings. And of course, then the optimal policy is unchanged. You should be happy to issue the CBDC, and you should run the Friedman rule. So note, so here there's no, I'm saying electronic to emphasize there's no new technology involved. There's nothing about blockchain involved, right? And this could have been done long ago. And in fact, something like this was advocated by Tobin in the 1980s. So why haven't we done this previously? I think there are a variety of reasons, perhaps. But I think one important part of the story is this fear of disintermediating banks. And so here I've listed 3 quotes from the recent CBDC-oriented debate about where policymakers are saying, look, if we make outside money too attractive, if we offer this sort of more convenient form of it, then if people take their money out of retail bank deposits, put it into the CBDC, that could lead to a loss of low cost and stable funding for banks. Consequence could be higher interest rate on bank loans. And at what point do the benefits, whatever they are, of a CBDC get outweighed by the negative consequences of the central bank disintermediating a large part of bank business models?
This is the last session, so we have lots of time, right? So I'm going to interrupt.
Yeah,
a little.
Sure.
This paper by Rocheteau, Zhang, and I think Russell Wong, they talk about reputational banking. So my caricature of that paper, if you put banks out of business, that's a bad thing. It's like saying if we cure COVID, well, that's going to put a lot of doctors out of work. And that's a shame because doctors are really nice to have over for dinner and at cocktail parties. They make good conversation. It's a completely misguided view because you can hire doctors to come over. They could be independent contractors making conversation. They don't need to do these 2 jobs at once. So if bankers are providing some role or some function in society, we can have them do that, even if we get rid of the COVID or other disease, which contributes to paper money being not so efficient.
Yeah,
So you're not confused about that because it came up in conversations the other day, but I think people are confused about that. Of course, when you invent the automobile, you put blacksmiths out of business.
Right.
Now,
No,
that's bad because blacksmiths are really strong and they can help you carry your piano, but they don't need to do the two jobs at once.
yeah. So that's absolutely a good point. And what I was going to say, which partially addresses this, is okay. So people are talking about this. We have now, I've sort of set up a simple model where disintermediation does occur, but the disintermediation, that model was a good thing, right? So question, are maybe these concerns are just completely misguided. People aren't, don't appreciate that the disintermediation would actually be an improvement in efficiency, or maybe they're in the pockets of the bankers, who knows? Okay, so that's one possibility, and I think that's a real possibility. But, here's another one, and this is the heart of the paper with Daniel I mentioned at the beginning, is suppose we wanted to get those concerns into this type of model. Here's one small modification to the model that sort of rationalizes the concerns or makes them appear, right? Just suppose that instead of bankers being able to credibly pledge all of their future income, suppose they can only credibly pledge a fraction theta of their output, right? So, and you can think of a variety of reasons, underlying frictions that would generate this. Right, so the only change now is that the funding constraint is that in order to be able to borrow, a banker has to have not just enough future income, but enough pledgeable income to cover the cost of the market cost of borrowing, 1 plus RD. Okay, so why is this a big difference? Because now when we look at in an equilibrium, now it could be the case that there are some bankers who have socially efficient projects who are not getting funded, depending on the interest rate. So in the baseline model, it was the case that if bankers who had a return of 1 over beta always got funded for any interest rate. And if there was a liquidity premium, some of the inefficient guys got funded too, right? But now this pledgeability constraint shifts the cutoff up, right? And depending on the interest rate, you can have some guys who are socially efficient, but who are not getting funded. And so a policy introducing digital currency, say that increases the interest rate on deposits, may be disintermediating good projects rather than disintermediating bad projects. All right. So in other words, this is kind of repeating what I just said. So adding this financial friction introduces a trade-off when we talk about introducing outside money. So making outside money more attractive, offering, say, a higher rate of real rate of return. It still has the benefits in terms of people are going to hold higher money balances, and that's good in terms of getting efficient levels of DM trade. But now the disintermediation may be we're crowding out good projects instead of crowding out bad projects. And maybe that's one way of rationalizing the concerns that some people have expressed. Okay, so what are the implications if that's the way the environment is? Well, now whether or not it's not so obvious now that having a digital currency or introducing outside money is going to raise welfare here. What we do in the papers is we give some results. We can show you that introducing a CBDC, which again is just electronic outside money, and choosing the interest rate on it optimally, or setting that rate of return optimally, that's going to raise welfare if the supply of high return projects from bankers is sufficiently scarce. Or you could think of it as, if the liquidity premium is big enough in the environment in the equilibrium with no outside money, then outside money is going to help. Or if in the environment with no outside money, there was actually overinvestment, which is also going to tend to happen when the liquidity premium is large, then CBDC is going to be useful in raising welfare. Okay, how are we doing on time? So maybe in the interest of time, I'm going to skip the discussion of how the optimal policy depends on this pledgeability constraint. Yeah, let me skip that and let me go on. So the next point I want to make is, okay, so we have that environment. There's only one type of meeting. All the meetings are the same. You might want outside money in those meetings. And if those meetings require electronic money, the outside money needs to be electronic.
So, Todd, can I ask you a question?
Yeah.
So the policy debate, I don't know that I know the policy debate is, but it seems like Dodd-Frank and so on, banks were taking too much leverage. So if anything, there's all kinds of regulations to bring leverage down. So, I mean, but this is a justification, or I don't know.
Yeah, okay, but when we think about leverage there, I mean, can I think about that as overinvestment? They were going into projects that were, low on the return spectrum or high on the risk spectrum. And so, if you go back to, if you didn't introduce, so if you looked at the original economy with no currency at all here, just the inside money economy, and you see, that bankers with really low returns are being funded, you might be tempted there to say, okay, well, the bankers are too leveraged. Too many of these guys are investing. Let's regulate that. Of course, they were creating inside money that was useful. I don't know if that addresses what you had in mind, Ricardo.
No, I thought the theta parameter I interpreted as banks cannot lever enough.
Yeah. Okay.
And all of us, but then that doesn't seem to be.
Yeah. That's right. I would think of it differently. Yeah.
So another way is like, can you use the fact that the Fed feels they need to regulate more banks as sufficient statistics to tell you that you want to crowd out these guys?
Yeah, I don't know. I mean, so now this is like
it.
Pure speculation at this point, but yeah, I think there's something to that, right? The idea that how do you discipline banks? And I was gonna mention this later on in a different context. How do you discipline banks? You can regulate them, or you can offer people another alternative, right? And so you could think of, in some ways, offering here CBDC gives people an alternative that disciplines banks, keeps them from investing in projects that have too low of a return. And then speculatively, maybe if you add in risk, projects with differing degrees of risk, maybe it keeps banks away from the projects with sort of inefficiently high levels of risk.
So there's nothing new under the sun. This is, undergraduate economics. This is not to insult your paper at all. It's
and my goal here was to present it so it looked like that. That's right.
So here's one way to state the issue. If government does X, the private sector will reduce Y. Is that a good idea? Well, it depends if we had too much Y or too little Y without government.
Yeah, okay.
Everything you do in policy that comes down to that. Then the other issue, government does this in a lot of areas, and I'm kind of with Milton Friedman. I'm skeptical. The government thought that retail liquor sales were not being somehow optimized. So at least in Canada and Pennsylvania, the government says, you want to buy wine or booze, you buy it from us. It just makes everything so much less efficient. They ruin it.
Yeah, so I agree, but let me point out one thing, which you know very well. But it's not just, you're not issuing outside money here just to crowd out inside money. You're issuing it to increase the total stock of real money balances. Right. So that's the one thing that's different. The one thing the governments can usefully do here is that they can create this outside asset.
Well, you know what Dave Altig would say? Say there's welfare theorems about liquor stores. There's not about money.
But like just point out that a lot of discussion that I see boils down to what you're saying, that they are afraid of issuing CBDC, and suddenly banks, like a big chunk of the financial sector, disappears, and people are going to complain about exactly what you're saying. That's now it's everything run by the government, right? Like they don't want to have the whole payment system be run by the Fed, and a lot of these
it'll be like trying to buy wine
goes in that direction.
No, yeah, that's right. And then you can say there are other ways which I'm going to get to down here, right? The Fed doesn't have to actually run anything. But what is important is that the Fed is somebody in the public sector is creating outside assets, and those outside assets are being used as a medium of exchange. So let me try and go forward and get into, because I think there's some interesting discussion to be had here, and I don't want to run out of time. So, but before I get to that, let me just make a point about multiple CBDCs. And this is also going to be completely obvious. It just took Daniel and I an embarrassingly long time to realize it. So CBDC, also people talk about it as a substitute, not just for bank deposits, but as potentially a substitute for physical currency. Like it's kind of like currency, but it's better in that it can pay interest and maybe it's more convenient, right? And so to capture that type of benefit, what we do in the paper is we have a second type of DN meeting. There's some sellers who only accept currency, and other sellers only accept deposits like before. Right. And then, to make this interesting, we say, okay, but these types of meetings might be different. In particular, the policymaker might feel differently about meetings that take place in cash. Some of those may be illicit activities, money laundering, whatever. So we'll allow for them to have a potentially lower social welfare weight. So this we borrow from Steve's paper in 2012. Right. And then, so now we've got sort of two potential roles or problems that CBDC is fixing. One is that physical currency as a form of currency can't bear interest, and maybe it's inconvenient. The other is there might be a shortage of electronic money in general, right? And so, and when you think about each of those problems in isolation, you could think about what the optimal interest rate is, how attractive you want to make the digital currency. So if you're replacing physical currency, you just want to look at sort of how much trade you want in these cash meetings. Suppose we fix the inflation rate, well, then you just pick the interest rate on the digital currency to get the desired real rate of return. But that interest rate is typically going to be different from the interest rate that balances the concerns we talked about before, between the disintermediation concerns and the fixing the shortage of electronic money concerns. So it's like the policymaker, if the digital currency is potentially used both as a replacement for cash and as a replacement for bank deposits, then you've got these two different interest rates you'd like to have. What should you do? Well, sort of the obvious solution is you'd like to have two CBDCs, right? And this, may be technologically possible. You could have one digital currency that you design to be cash-like. So you want it to be a good substitute for cash, but only a good substitute for cash. In practice, maybe people have a stored value card, and maybe you can transfer balances from your phone to that card, but to spend the money on the card has to be physically present. You have to touch it with somebody else's card. Okay, and then for that CBDC, it's a new form of outside money replacing existing outside money. You can choose the interest rate you want to pay as a modified Friedman rule. And then separately, you might want to have this deposit-like CBDC where there's a debit card, you can use it on the internet, it runs over existing bank-based payment networks, right? And then you set the interest rate differently there. And as long as you can completely separate these two markets so that each can only use one type of CBDC, it's sort of easy. You solve two different problems. So this idea of having multiple CBDCs, we think hasn't gotten that much attention. Once we sort of realized it, we're surprised we haven't heard more about it. It has clear benefits in the environment I described. And I think it's likely to be useful in a variety of other environments as well. But there are some sort of strong technological requirements here, right? It really has to be the case that your cash-like CBDC cannot be used as a replacement for bank deposits, and the deposit-like CBDC cannot be used as a replacement for cash. Is that possible? I don't know. Those are technological questions. Maybe, but maybe not. It may be the case that you just can't, once you introduce a CBDC in a practical sense, it's going to be a decent substitute for both cash and deposits.
You might want to think about Coach Lakota's paper and follow-up work by several, including Suyong Shi, where it's good to have two monies or two assets to return. They never talk about whether that's feasible, but they show why it might be a good idea. It's isn't it?
Yeah, that's right. That's right. At some level, I think it's the same. It's the same idea, just showing up in this different setting. But that's right. Now, if it's not feasible, well, then you've got a harder policy problem. Then you've got to choose one interest rate, and you're thinking about in what types of meetings the money is going to be used, and what are sort of the marginal effects in each type of meeting. Okay, so again, there are a lot of details about that in the paper. In the interest of time, I'll skip over that here. There's some graphs related to that. So I want to spend some time here on these discussion topics. So let me start with central bank lending. And this came up yesterday in Harold's talk, right? So when people talk, if you're concerned about disintermediating banks, one of the first things people come back with is, well, the central bank could just turn around and lend to the banks. The central bank can effectively replace the lost deposits. Okay, so it turns out, and that sounds very natural, but it turns out in our model, central bank lending to banks is neutral in the following sense. So the central bank is, in the model, can determine the inflation rate, and it can determine the nominal interest rate it pays on the digital currency. So that means it can pin down the real return on holding digital currency. Then in equilibrium, competition and arbitrage are going to pin from that real return on digital currency. Competition and arbitrage are going to pin down the equilibrium interest rate on loans and on deposits, right? And those are going to pin down total real money balances and investment without making any mention of whether or not the central bank is lending to banks. Okay, so central bank lending can't affect any of these equilibrium values. What it does in our model actually is a central bank lending to banks crowds out private bank deposits 1 for 1. So fix the rate of return on digital currency, have the central bank lend $1 to banks. What's going to happen is buyers are going to shift $1 out of deposits and into digital currency. And this is a version of the equivalence result that Marcus Brunnermeier and Dirk Niepelt had in their paper. But notice what that means. So central bank lending can't be used to undo the disintermediation. It just has no effect in this setting.
You know, I always see Brunnermeier get more credit than he deserves, which is always. This crowding out is in many, many, many papers. It may not be CBDC, no, but it's
that's like right.
All literature, money and credit.
Yeah.
Versus commodity money. These guys didn't invent that idea.
Yeah, no, I agree. But you know, in defense of the paper, I think you know the paper was useful in terms of bringing these ideas and making them explicit in terms of CBDC. But I think they would even agree. It's not that there was something surprising about the result once you sort of set up the problem in the right way. But I just want to reinterpret that result in another way, talking about inside and outside money, which I think is kind of neat. So a different way of thinking about their equivalence result, which is closer to what they actually do in the paper. Suppose the central bank creates a CBDC by lending to banks. Like this is how it gets into circulation. The central bank creates CBDC, lends it to banks, right? And then, you know, the bankers in our model, the bankers would then use it to go out in the market. They buy goods to go into investment, and the buyers are going to be the ones holding the CBDC. Okay, so notice then CBDC would actually be inside money in the original sense of Gurley and Shaw. So this is something I learned from Ricardo's new Palgrave entry on inside and outside money. So when Gurley and Shaw talked about inside money, this is exactly what they were doing. They were talking about open market purchases by the central bank of private debt, right? So if the central bank creates the CBDC by lending to banks, this new money, the CBDC, it's issued, created by the central bank, but it's based on or backed by the private debt of the bankers. That is, if you take balance sheets, it's matched up on the balance sheet of the public sector, it's matched up with the debt of the private sector. So in those terms, the equivalence result is saying that inside CBDC, issuing inside CBDC is neutral, right? It's just replacing one form of inside money deposits with another, CBDC. It's sort of maybe not a surprise that that's neutral. So all of the benefits that we talked about before of issuing CBDC that weren't really about CBDC per se, and this is kind of, you know, Steve's point, but they're about having outside money that can be used in more widely, right? In some meetings where presently outside money is not available. All right, we're out of time, but let me quickly do. Yeah.
A quick question. So you say that central bank lending does not change the equilibrium, but the question is at which rate the central bank lends? Presumably, if they lend at a sufficiently low rate, it should have some effect on the equilibrium, right?
Right. I mean, so one way to think about it is the central bank is going to choose a quantity of deposits to place at banks, and they're going to earn the market rate on deposits. So right, you know, if the central bank uses this as a way to subsidize banks in some sense, well, that's going to affect things.
Right.
You know, Todd.
Yeah, go ahead, Steve.
Yeah, so I was going to say, so a lot of these issues came up when people initially introduced central banks, right?
Yeah,
at least
yeah.
some of them, you know. So like the Federal Reserve System. So part of that is like this view that it's like the private sector's screwed up, according, you know, from the point of view of the people who wrote the Federal Reserve Act. You know, prone to instability. And then they talk about, furnishing an elastic currency and whatnot. So there's so that's somewhat in your model, right?
Yeah, that's right. I mean, the model would be saying, the private sector is not great. The private sector is limited in its ability to create stable money by the amount of good projects out there.
Yeah,
and in the model, it just shows up as a liquidity premium, but more broadly, you could imagine it showing up in other dimensions.
So it could be like, so part of it being screwed up had to do with it's partly the government's fault that it was screwed up because they just sort of, didn't design the banking system properly.
Yeah.
And then there's like this Canadian experience where the seems like it's not screwed up. Like the private money system works pretty well, but then they come along and outlaw the private currency and put the central bank in place. And the question is, why did they do it? Well, so if you kind of read what people were talking about, it wasn't like they were stupid. They kind of had this idea that seems like having something to do with like price stability, like maybe even something that's kind of well run and functioning well in the sense it's not unstable. It's not somehow not, at least in their view, it's not producing the right optimal price stability or something.
I see. Yeah.
So I don't know what there is to that, but that seems to be what people were thinking at the time. And then the arguments in the Canadian case, the bankers were all against it. They're against the central bank because they, for reasons that are like you're talking about, where they,
right.
But of course it didn't kill any Canadian banks. The banks are all still there, same damn
That's
bank.
right. That's right. Yeah, that's an interesting point. And I think one of the takeaways I was going to offer at the end is a lot of these issues we're talking about with response to both private and public digital currencies are sort of classic issues in monetary theory, and it's a chance to revisit them, think about why some decisions were made in the past. Yeah, and I don't have any particular insight into the Canadian example. I just ask you whenever I have questions. So we're low on time. Let me skip the narrow bank thing, but I do want to talk about stablecoins, sort of the most speculative thing. So Bruno, can I have like 2 minutes?
You can go as long as you want. I got nothing.
Well, okay.
Brent says that's true.
Okay. Well, okay. Let me just go with stablecoins. So, and this came up a bit in Harold's talk yesterday. So what is a stablecoin? A crypto asset that aims to maintain a stable value relative to some existing asset, maybe say the US dollar in the case of Tether and USDC. So at first, right, this seems like a strange idea, right? If I want an asset whose value is stable relative to the US dollar, we have those, right? We have bank deposits. Why not just put your money in the bank? Right? And I think the answer is, well, for some activities, the bank account money is not that useful. The money needs to be tokenized or usable in a blockchain-based transaction. So I'm not an expert on the technology stuff here, but here's my understanding, right? Suppose I wanted to go out and buy Bitcoin using dollars, and I don't want to go through an intermediary. I don't trust the exchanges. I just want to do a direct transaction with some holder of Bitcoin who is some unknown entity, right? So what do I want? I want to be sure that both legs of the transfer go through together, right? That I transfer the dollars I have to the seller if and only if the Bitcoin are transferred to me. That is, I want some form of delivery versus payment. Right? That can be done, apparently, I'm told, using smart contracts, right? But it cannot be done using the money in my checking account, right? I need that the money in my checking account's electronic. Maybe you call that digital, I don't know, but it's certainly not blockchain friendly, right? And so the way I understand stable coins is like, these are like bank deposits, but they have this different property. They're tokenized, meaning they can be transferred on the blockchain using, these types of contracts. So stable coins seem mostly to be a form of inside money. That is, Tether at least is backed by, I don't know what, it's a bunch of assets that include commercial paper, loans, and some other things. And so, so it's like if I wanted to think about this in terms of the model, it's like we've developed a new type of meeting, right? And so for some types of transactions, you need not just electronic money, you need tokenized money. And people are out there developing inside tokenized money. And that sort of raises an interesting question. Is there a role for outside tokenized money? I don't know. Is there a problem here that the CBDC might solve? The previous discussion, I would say, encourages us to think about, well, what's the optimum quantity of tokenized money, and can or will the private sector produce that quantity? I don't know, or what are the constraints on the production of inside tokenized money?
Sorry, Todd, who guarantees the exchange rate is pegged there? I mean, who's?
Yeah, that's a good question. I mean, they claim, right? And that's kind of it. I'm not even sure what your legal claim is when you're holding a tether coin. Maybe somebody else here knows. But basically, it's you're hoping that they're going to intervene if the exchange rate moves. They say they're going to intervene using their assets to keep it pegged. But you're kind of hoping that works. Is that what you were asking?
Yeah. I was wondering whether there's somebody's reputation on the line for that. I mean,
well, yeah, okay. So
you're not committed. You're not committed in a blockchain chain or a smart contract way to that.
No. In that sense, no. Right. There's no like foolproof thing that says you can see this is going to be pegged. It's really. I mean, it's a good question. Why don't they run off with the assets? I don't know. There must be some reputation effects and future profits, but.
In Argentina, they did it with the currency board, right?
Mm-hmm.
The central bank stood ready to convert pesos into dollars 1 for 1. Now you might wonder, what if they ran out of dollars?
Yeah, no, that's right.
You see, the beauty of this policy is if you stand ready to convert dollars into pesos, pesos into dollars 1 for 1, then nobody will bother converting. So you actually don't need the dollars. So you're tempted to spend them. But then you could have a run on the currency board, which I don't think people have analyzed, but it sounds like something you should be working on.
Yeah, no, I think that's right. Although I think, thinking of these stable coins, I think of them as more like a bank or a money market mutual fund. With the currency board, you've got the issue that people had private bank deposits denominated in dollars. And so the central bank in Argentina was trying to peg the whole stock of money using only a smaller base of actual dollar holdings. In principle, think of a money market mutual fund, a prime fund that's holding a bunch of commercial paper. In principle, they have the dollar value of their assets should be equal to the dollar value of their claims at par. But then. I agree with you. The run issue still comes up. That's going to be the rest of this slide. That there are going to be financial stability concerns, because there's a question of how you value their assets, and if they had to sell them today in a run, would they really be worth their face value? Maybe not. Okay, so let me just end with this. So if we think of stable coins as inside money in these new types of transactions or these new types of meetings. Well, then, let's just point out that much of the inside money we currently have, bank deposits, money market mutual funds, it's tightly regulated, one, and also a lot of it has access to a lender of last resort precisely to deal with these run type issues. And the inside money in the form of stable coins has neither of these. And so that seems like, a big concern. So question going back to this sort of speculative thing about crowding out bad investment, is there a role for outside tokenized money in the form of CBDC to displace this seemingly risky inside money? I don't know. That seems to me like an interesting question to think about. All right, so that's it. So I think new types of digital currency raise a, yeah, go ahead, Randy.
So to the extent you want to think of central bank digital currency as simply an electronic version of paper currency, and why can't I say this? So with paper currency, you get it from the government. You don't want to keep it in your pocket for various reasons, so you deposit it in the bank, etc. Now suppose you get central bank digital currency. Why don't you deposit that in a commercial bank and everything is business as usual?
I mean, but I guess I would ask back at, if you wanted to deposit the money in the bank in the first part of the example, I would say, well, what you wanted was bank deposits. You wanted to hold electronic money in the form of a bank deposit. That's separate from saying, there is some currency you do want to hold. So I think of you currently holding.
I think for a payment instrument, it's nice to have this government maybe outside asset. My bank deposits are just claims on this outside asset. But the reason I don't want to keep outside asset in the central bank is I want to earn interest on it, which I get from the commercial banks because they're lending this. It works exactly like paper money, except you save on the paper. Now, I could be confused, but it seems like an obvious question. I mean, I could imagine one thing, paper money is risky to carry it around. It might get lost or stolen. If you already have that safety feature with central bank digital currency, maybe you don't need the bank for safekeeping. But having said that, you've kind of been pushing, among other views, this position that central bank digital currency is the same as outside money that we've always had, except it's electronic, not paper. And if that's potentially the case, we should be able to run business as usual.
Okay. I think I see what you're saying. Yes, except for it is more attractive. It potentially pays you interest, and as you said, you're less likely to lose it. It's sort of easier to carry around. And that means, when you think about your portfolio choice, how much cash do I want to hold and how much money in the bank? When the cash is electronic, you may be holding a lot more currency, a lot more of the digital currency in place of, funds that you previously kept in your bank. All right. And then from the bank's point of view, that doesn't feel like business as usual.
Yeah, Randy, I think the vision they have is you're going to make a purchase online. You can't use your paper money, but you can use your debit card.
Yeah.
And so that gives, cheap funding to the bank because some of the deposits, they give you nothing for it, but you get this, liquidity rent because you can use it. So what if the Fed just lets you access FedWire and transfer money the way banks do? All the transaction money for online stuff you wouldn't put in the bank, maybe you just put it at the Fed, safer, run proof. You might get better interest because the other guys, have whatever. So
yeah, I guess it comes down to, as people have mentioned many times, what interest rate the government's paying on central bank digital currency. I guess they could drive commercial banks out of business by paying high interest rates, or keep them in business by paying low or zero interest rates. In which case you would deposit it not for the convenience or safety, but for the interest.
Yeah, that's exactly right. And so the optimal policy analysis in our paper is all about finding the optimal interest rate in there, right? Balancing these different concerns.
I mean, or they could just let Jamie McAndrews's narrow bank operate.
Yeah.
That bank wouldn't be crowded out.
Right. So that's the part I skipped, the narrow banks. If I can go back. Right. So in the framework I talked about, I don't know. Now, Bruno, you're going to signal to me when I should stop, right? Otherwise, I'm going to keep going.
So why don't you do the following? Like, the discussion is going very well. So let's officially terminate it now. Like, just conclude in few words, but then let's just keep going, like, the discussion, because it's nice.
Okay. Thanks, everybody. So then, on the narrow bank issue, so in the framework as I was talking about it, here's something that would be equivalent to a CBDC is exactly what Ricardo was saying. So have a private bank, it issues interest-bearing deposits, and those deposits are backed 100% by interest-bearing reserves at the central bank. Or as Steve said earlier, it could be backed by government bonds as long as you feel good enough about the liquidity of those bonds. So that's going to keep the bank safe. So then you could ask, okay, so I already gave an answer, but is that arrangement equivalent to having a CBDC? And it's sort of interesting that the IMF, so Tobias Adrian and Thomas Mancini-Griffoli say yes, they call that a synthetic CBDC. And they say that's probably, the most practical way of having CBDC. And then there's this paper, a BIS paper put out by a collection of central banks as a joint report on CBDC, and they say no. They define a CBDC to be a direct liability of the central bank. And they have a section titled Synthetic CBDC is not a CBDC. Okay, and I was kind of, I wasn't sure what to make of this.
What does it mean to be a direct liability of the central bank? That seems like It's
Yeah,
bullshit.
okay. Okay. So
Because
that's a
paper
question.
currency is not a liability of the central bank, and neither would digital currency be a liability.
Yeah. So, and we've had this discussion before. I want to point out that I'm just quoting their statement. But also, you know, I think they're talking in an accounting sense, right? You create the balance sheets, and this thing that I'm holding is on the balance sheet of the central bank. It's not whereas, you know, with a narrow bank, what I'm holding is a liability of the narrow bank.
Maybe
Okay.
they're confused.
Yeah. Okay. Maybe always a possibility. But let me give you one thing which might be interesting, right? So deposits in a narrow bank, assuming I got this right, are outside money, right? So deposits in a narrow bank, this is money that's backed directly, you know, by reserves, some asset that is not in zero net supply within the private sector of the economy. Again, just taking this from Ricardo's New Palgrave entry, right? So you know, as I said, in our framework, it's all about inside money and outside money. So if this is another way of creating outside money that is electronic and can be used in these electronic meetings, and it's going to be equivalent to CBDC in our meeting. All right. So notice, and it's going to be equivalent as long as if there are no incentive constraints. So now you have to think of who's operating the narrow bank. And as long as there are no incentive constraints that the narrow banker can just match deposits and reserves and can't run away with anything, they're going to be equivalent. And maybe that's, you'd think the incentive constraints would be smaller at a narrow or weaker or less binding at a narrow bank because the assets are easier to monitor. Maybe it's just reserves instead of some opaque loans. But if you think there are incentive constraints there, so narrow bankers can only pledge a fraction of their reserves, and that means effectively they have to hold some own equity, then the two things become different, right? And a direct CBDC in a sense is more efficient because it's bypassing the banker's incentive constraint. And this matches up sort of with the language before, right? It's more efficient that I'm holding a direct something, let me not say liability, but I'm holding something directly issued by the central bank, rather than having a banker hold that and issue a claim to me. If the banker has a binding incentive constraint there, that's going to create an inefficiency. So something like this happens in Steve's CBDC paper, which I think is really neat. So this is not in our paper, I should say, but he works it out, and that's potentially one of the real benefits of having actually a CBDC as opposed to narrow banks. And maybe it's one way of interpreting these comments that the BIS and other are making. Okay, so Ricardo, in a sense, that was a long answer to your question or comment.
Just a comment there, like the pledge a fraction of that was exactly the case with the narrow bank that the Fed didn't allow, right? Like they basically were imposing these guys to hold capital, and they were saying, why we have to hold capital if we are a narrow bank? There's no risk asset.
Yeah.
Was not that they prohibited the narrow bank. They basically said, okay, but you need to hold capital against this. And that makes the business just like not profitable because there was this cost of holding this capital, and they were just making
that's right
because of the reserves, right?
So
yeah, that was endogenous.
They don't forbid him from being a carpenter, but he can't use a hammer. I mean, it's
Well, no, it's just saying that the pledge of fraction was endogenous. It was the Fed imposing the fraction. It was not like incentive constraint imposed by some, or maybe it was, and the Fed was just internalizing that. But like, it was the Fed imposing the constraint.
Right. I would interpret it differently. I would say that it seemed likely that the narrow bank would be able to attract customers without holding much capital. And that would be the customers thinking that they were able to monitor well. And then the Fed didn't want to allow it because then they saw it as this case. They said that's equivalent to a CBDC, and we're nervous for whatever reason about a CBDC. Yeah, so we're going to block it.
It's like there is this idea, people have been talking about narrow banking forever, and that's one of the arguments is that you basically avoid all these regulatory constraints.
Yeah.
Get rid of deposit insurance and capital requirements because you don't need them. So
And
that's the argument these narrow, Jamie and his friends were using, I guess, but the Fed didn't want to.
I always thought the flip side of the argument, right, would be a great thing because we avoid all these things. But unfortunately, the private sector doesn't want to do that. So we have to regulate these guys. And then apparently now we flip it. No, the private sector wants to do, but we prefer them not doing it, and we keep the regulations on for whatever reason it was.
Yeah, I agree. That's really interesting. Just, just to say the same thing. So historically, the debate was, should we require banks to be narrow banks?
Yeah.
And now it's just like, should we even allow it? Really, and the question of allowing narrow banks didn't come up before because the Fed wasn't paying interest on reserves. And if you can't earn interest on the reserves as a narrow bank, it's not going to be profitable. So it's once all reserves became interest bearing at something like the market interest rate, now narrow banking potentially became a viable business. And that forced the Fed to make a decision about whether they were going to allow it or not.
Well, there's another view of narrow banking, which may be less relevant, but they could take deposits, sit on them, and charge you a fee for storage, like the Goldsmith bankers. And you might be willing to do that because you get safekeeping, and you may be able to use electronic payment methods with this. So
yeah, okay. But when you say sit on them, what are the assets? I mean,
currency, claims on currency.
Okay, yeah, that's right. And I think the narrow bank could do this something. I don't know, maybe not, but you're right. So it's just that the asset isn't interest bearing.
Right, it could have negative interest.
And I think, yeah.
Pay Goldsmiths a fee for storing your stuff.
Well, yeah, no, that's right. So the bank's not earning a good return on their assets. And so that business has been feasible for a long time. But the fact that we don't see many banks like that seems to indicate there's not much demand for it. I don't know.
No, but that could be the bank that tokenizes, which you were saying before.
Yeah, okay, right. But then there's a question of, and this has been sort of the debate over Tether. What exactly are the assets they're holding? They initially didn't give any details and just said they were holding dollars, kind of as if they had a low interest rate, very safe assets. And then I think as it came out, they're holding all sorts of stuff, including loans to themselves.
Yeah, so
no, I'm saying if there's a demand for these tokenized dollars, I mean, the model that Randy was proposing is you take the narrow bank, you give debit cards, and you also tokenize the dollars for people, and you charge them a fee.
Yeah, no, that's right.
And then you regulate it, so people should probably trust you more because you're regulated by the Fed. Yeah.
Okay. Yeah.
So that's feasible. I think that's what Todd was saying. If you're not getting interest on reserves, you could do that. We could start this business today. We get zero interest on reserves. And that's what James Bank were allowed to do. What they were not allowed to do is run that business and get interest on reserves. Right? Like, so you need to invest something.
Yeah, I don't see the rationale for not letting them pass on the interest, to be honest, but fine. I mean,
yeah.
So can I ask you something?
But then let me just say one more thing to Ricardo. So
been doing for decades, they issue these things called traveler's checks. They bear negative interest in the sense that the purchase price is above their face value, and they provide safety. And I don't know what they're backed by, actually. I guess American Express is a good name. I guess that's not a narrow bank. They're not exactly keeping your cash in a vault.
Right. I don't know, but I expect American Express was making good money doing that, investing the proceeds.
Yep.
But this goes back to what I was going to say to Ricardo, which is the tokenized thing. Someone could do that, as you were describing. Somebody else might do something similar, but invest in riskier assets. I mean, commercial paper and stuff. And then it's a question of who's going to attract the customers.
Yeah, sure. I mean, let 1,000 flowers bloom, right? I mean.
Yeah. Maybe. Unless you think there's some externalities related to financial stability, fire sales, whatever.
Yeah, the other thing I don't see is like all these papers about like definancing the banks. I mean, I'd like to see a model where the bank doesn't do anything to survive. So in your model, it has a really hard constraint. So there's nothing they can do with that data. But maybe they offer better products if you want to deposit. Sure, maybe interest rates go up a bit, but customers are presumably earning more, so it's not, it's just a transfer. Customers may choose to, what I'm saying? Like people who invest in more sophisticated products now might go through the bank, and before they didn't. So maybe it would be taking some clients from shadow bank. I don't know. It's not obvious that this is going to be, because whatever, 60, 70% of their funding is deposits. They're just going to lose that altogether. It's just not,
No, for sure, right? I mean, and in in a little way in our model, right? The deposit rate goes up, they just pay a higher rate, and then that limits, the investment opportunities that are profitable for them. But and if you bring in market power, like the Endolfato paper and the Jonathan Chu and others paper, right? Then you can get more of what you're saying, even what you're saying and beyond, right? You're just forcing the bankers to in effect become more competitive. But you're right. I mean, there are a lot of dimensions on which they'll adjust.
This is like saying the Bank of Canada should start a rock band because, yes, I mean, what do you call it? Let's say the Guess Who are making too much money in royalties. The Bank of Canada cannot produce good music. And they tried it with auto insurance, they tried it with liquor stores, and almost airlines, they kind of screwed that up too. And the worst thing is when the government does this, they're not playing with their own money, they're playing with my money. So they're going to enter into commercial banking the same way they entered into auto insurance in many Canadian provinces, and the way, Switzerland and Lithuania has to have their own airline, and the way they enter into liquor sales in Pennsylvania. This idea that the government should be in there, providing alternatives to the private sector to keep the private sector somehow more efficient is a dangerous idea.
Randy, one thing, except that, a lot of those are used as payments, and they are already in the business of giving you payments instruments. So it's not so alien. They're already there. Yeah.
The idea, this is again, the Altec argument, money is different from liquor, airlines, and music. There's no welfare theorem for money. So I can't push that too far. But it is true that you got to be careful of the position that the government says they could do it better. So they want to do as many things as they can, because they like being involved. I understand there's externalities in things like public schools. You maybe do want the government, maybe not. I don't know.
Also, don't forget, in the Andolfat, in lots of these market power stories, at the end of the day, they don't do anything. They just threat.
Yeah.
Right.
So they don't actually have to make any records. They could just threaten to get to better charge less for their concerts.
That's
or
right.
Band.
That's right.
Randy, I think that something that Ricardo was maybe hinting is that there is a theory of there is already a distortion. The banks are already regulated, so it's not like once you have one intervention, one distortion, a second distortion.
That theory rationalizes everything.
Yeah, but for the case of that was talk about why I hear this at the Fed all the time, we need to reduce our footprint, and then they do a lot of things that seems to be protecting market power for banks, and seems that the reason is because they don't want to take market power from banks. They are afraid of taking out. So it's very hard to. I'm totally in favor of the idea of reducing government intervention, but it's very hard to justify why we some intervention that you want to protect banks. You don't want to do something to protect banks. That it's a little bit twisted there. And I don't right.
Especially because if bankers provide other services, they can be hired as independent contractors to perform those services without having to fulfill these multiple tasks. I mean, one of the classic issues is why are banks doing all these different things? Wallace emphasizes that a lot, but it goes way back. They take deposits, they issue claims which are liquid, they do delegated monitoring, they seek out investment and evaluate investment opportunities, et cetera, et cetera. Is it efficient for one institution to perform all these tasks? Maybe not. Although then again, why didn't the market provide unbundled versions of these things? Maybe they did.
Right. The new fintech thing is just trying to do that, right? All these crowdfunding and all these pay tech companies, they're just trying to separate payment and lending. I mean, there is a lot of regulatory constraint on these things, I think.
See, I don't want to sound like a radical, crazy person, but should we be skeptical of research by central bank economists who are researching?
We should. We should, for sure.
Randy, in general, you should be skeptical of any research to be critical.
When I suggest university professors must be subsidized, I mean that sincerely.
I'm pretty sure there is a review of financial studies paper that says that if you had research that's favor quantitative easing, you are more likely to be promoted at the Fed. Not only the Fed, they look at several central banks and they have a huge data set and research that people who have research and finds that are favored quantitative easing over the last 10 years were more likely to be promoted in their careers at the Fed than the economists who are doing something else. So yeah, I think we should.
Did they put a dummy for the Friedman rule? What happened if you propose that?
Yeah, Awaya Gary used to say that in a briefing.
Oh, I saw him do that.
Yeah, you were there. You were alive.
Yeah, no, we'd have to go to these meetings with Gary Stern, and that's what Rao would say.
But it's just what all models say, so of course it's what he should say.
So, can I go back to the CBDC thing? Have you guys you know this better than I do, and we're having all this discussion of what to do with CBDC. Did any of these papers incorporate some night and uncertainty? Because in your model, it seems to be say in Todd.
What are you going to come up with next? Some radical feminist model? Maybe an uncertainty?
But what do you have in mind, Bruno?
No, because I talk with people, it seems just to be, they are really afraid. So say in your model, if you have no clue, say you know for sure a CBDC would improve welfare, but you have no clue what exact should be the interest rate you put. Could be depends on parameters of the model, and you have some uncertainty and ambiguity uncertainty. Now, if you don't put, say you already estimate from your past, you know exactly what you should do, right? You might not be moving just because you're afraid. You're afraid of not knowing the distribution of interest rates you're supposed to use, and afraid of that risk. Do you know what I mean? Sometimes you talk with these guys, it seems to be a lot of model uncertainty, and they don't want to act a little bit just because they don't know exactly what's gonna happen, and they are a little bit more than risk aversion. It's really ambiguity aversion. I don't know. If
Bruno, to that. So that's interesting. So we have a colleague did something like estimating the demand of a CBDC. And then the natural question would be, what interest do you want to give to make sure that demand is not too wild? It turns out the estimate is fairly wild. So what you end up with doing is just giving the set of all the possible influence. I mean, for each interest, what's the huge set of demand that could look like? And potentially she could do that just to see if we want to, I don't know what the criteria would be, to think about a max mean criteria to have an interest rate to reach that criteria. That would be a natural place to look at, right? I think one reason people don't put that in is there are so many empirical or estimation type of work on this CBDC. Mostly it's theory, so it's not so clear where that max mean type of thing come from, right?
Mm-hmm. I mean, I agree with Bruno on one thing. On some of these issues, like say global warming, I'm very conservative because the downside risk of screwing up the environment could be, literally fatal, right? So even if it has present value, positive of doing some project, maybe the status quo was kind of comfortable. But however, having said that, the financial sector in capitalist economies, or more generally the capitalist market system, is extremely resilient. Okay, there's a crisis every 50 years or something, but it's amazing how the market responds pretty well. So I just fail to see how whether central bank does digital currency or not is going to be something like destroying the ozone. I mean, it's a triviality that
Right,
the free market will work around it.
That's not clear at all, right? So I mean, you have no idea what's going to happen over the next few years with kind of private digital currencies, where that's going, and what's happening to physical currency, and I don't know, maybe there's something important going on to do with how monetary policy works, and all kinds of different views about how important the central bank is. Does it need to have its foot in the retail payments business to work? I don't know, so it's really not obvious to me at all what at the outset what's going on, so it's research is important. How else are you going to answer these questions now except with theory? As you was saying, we don't have any empirical evidence to go on, so it's an important time, I don't think I want to dismiss this stuff.
Yeah, and I think like a little bit like just corroborate what you're saying. Like I think it's a lot. That's exactly why research is so important, right? Because we don't have this many crises, part of because officials are very conservative in doing policy, and what we need to do is like generate enough research so they have confidence in make policy change.
Right, which all led to the current system where they use the ISLM model to change the overnight nominal interest rate of the interbank market, which is supposed to cure everything from COVID to the recession. Right, so the Fed has a terrible track record. Look at some of this stuff by the people at Cato. I mean, it's shocking how bad the Fed has been in the last 100 years. I shouldn't say this because this is not on the Fed website, right? I still need my consulting gig. But this is actually a serious problem. The Fed central banks are intervening in the economy all the time, and they think it's a good thing. But of course, it's their job. If someone proved it was not a good thing, they'd be out on the streets waiting for unemployment insurance.
Yeah,
so a lot of self-interest in what you guys do.
No, I totally buy that, and I think, and I go back to the main problem has always been like we don't have a good way to generate data, right? Like it's very hard to say, well, let's try to change overnight the Fed. Let's create 10 USs and run an experiment. But yeah, we are not playing Daniela's game with a lab, right? You cannot change the Fed and run experiments.
Hundreds of years in hundreds of countries, different experience with commodity money, paper money, central banking, no central banking, wildcat banking, multiple, the bimetal standard, the gold standard. What's interesting is the economy seems to always work. Somehow they get around all this meddling. That's a lot of evidence. Now, you also have some evidence like some of the former Soviet economies, like they try to introduce a new currency in the Ukraine and it's a major disaster. Obviously, Latin America has had tremendous disasters. These are typically caused by and not cured by the central bank. So there's quite a bit of evidence. Right? We have experiences of inflation everywhere from -4% to 4 trillion%. Huge variability in observations over, as I say, many centuries and many, many countries. I guess I'm saying two conflicting things. Monetary policy obviously matters. Look at Latin America. You can destroy an economy with inflation. Then again, you can say monetary policy, central bank, somehow the system doesn't matter because it works on the gold standard, it works on the paper standard, it works under bimetallism. There's a lot of different arrangements. So whether or not the Bank of Canada introduces CBDC, is that really a big deal? Maybe not.
Well, potentially, right? You say maybe not, but we need to know, right? Before we do anything. That's where research is important. And by the way, this is an area of research that's not Keynesian most of the part.
Not easy?
They don't have money.
Not Keynesian.
Oh,
Yeah.
right. How could it be? Right.
Oh, no, they can make it. They can make it so. There are people, there are people that are making arguments that'll be all like, CBDC is a wonderful thing because it allows, negative nominal interest rates without these issues to do with, people running off to, hold zero interest currency.
You can shift that LM curve all the way to the left. No zero lower bound. Keynesian's delight.
So if I can go back to Bruno's question, I hadn't really thought about this model uncertainty, but I think we could get some of what you're talking about even without that. If we just put in uncertainty, the policymaker is uncertain about the distribution of projects. And so sort of like the policymaker is going to be uncertain about where you want the interest rate to be. I mean, it's certainly the case if you introduce a CBDC and you set the interest rate too high, you can lower welfare in our model because you end up killing a bunch of good projects. And so I think, but the payoffs are asymmetric. If you set the interest rate too low, no one uses it and it doesn't matter. And I think with that asymmetry, if you just introduce uncertainty, it might be the central bank ends up being conservative, right? You want to, if you're going to make an error, you're going to make an error. You want to be on the low side. And if you're on the low side, people use it less.
Yeah, but
so maybe that captures a little bit of what you're thinking.
Yeah. So if you're just risk averse in that setting, right? Like if you're just risk aversion,
just risk aversion, right?
And just set it very low, and then nothing happens, and then you can go increasing by epsilon every year, see what like.
Well, if you think the environment's stationary.
Yeah. Yeah. The question is like if there's something like that, if we introduce. We are gonna just send all the banks, like we'll file for bankruptcy, and we have a great financial crisis. I think that I put epsilon probabilities on that scenario, and then I max mean things, and I just don't introduce. I think that's.
Also, by those rules, you don't leave the house.
Right.
Well, I mean, have you met some Fed officials? I think they kind of.
So, there was a big debate in Canada. This reminds me of the same thing. Should we move from the English system to the metric system? It's kind of related. Should central banks swap out paper currency for digital currency? Some level, it just can't matter. There was some particularly Keynesian analysis of the metric thing. This is the ultimate in Keynesianism. He says, in Canadian football, you have to go 10 yards to make a first down, just like American football. But in Canadian football, you have only 3 tries to make the 10 yards, and it's very difficult. Suppose we switch to the metric system. 10 meters is going to be even harder. What do you think of that logic? Are you guys Keynesian, or do you not see the fallacy of this logic? You don't have to use meters in football just because meters are the standard of value for other purposes, like the speed limit. They use furlongs in horse racing.
Yeah.
Well, maybe it's a good time to call it a day, huh? I want to say it was an excellent conference. Thanks to everybody for participating.
Thank you, everybody.
Yeah, thanks to the organizers. Really great. Thanks.
Thanks, you guys.
Thank you.
By the way, these things are just so easy, right? They don't work. So, we should do this more often. It's fun to see people present a purpose and go out to dinner and stuff, but when that's not feasible, at least I get to see, I like Lucie's presentation a lot. The paper with